Good morning. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, cautious consumers weigh on Target earnings. The retail chain posted its first earnings beat in a year, but reported shrinking profit and margins and offered a cautious full-year outlook. Target same-store sales data that increased in the quarter, but the CEO, Brian Cornell, emphasized a challenging environment as consumer spending shifts away from discretionary categories. The company saw strong sales in food, beauty, and essentials, but weaker action in other categories. Target said it could take nearly 2 years to return to its pre-COVID rate of profitability. Second thing you need to know, Zoom posted better than expected results in the fourth quarter, beating on top and bottom lines and forecasting upbeat guidance for the year. The company's revenue jumped 4% year over year, still a dramatic slowdown from the large gains that it enjoyed during the height of the pandemic. Its enterprise revenue rose 18%, while its online revenue fell up 10%. And looking ahead, the company is ready to get in on the AI action. It said it's going to start to integrate more AI into its products and forecasted annual profit above the street's expectations. However, its sales forecasts did come in short, and analysts were closely watching these results after the company laid off about 15% of its workforce in the quarter. Third thing you need to know, the floodgates have opened for the chips sector. The U.S. has launched its first funding opportunity under the CHIPS Act. So semiconductor makers, they now have their first chance to apply for a piece of the $50 billion in government funds for chip-making projects in the U.S. Julie Hyman had a chance to sit down with the U.S. Secretary of Commerce, who is behind the launch. She emphasized the need for sophisticated semiconductor manufacturing in the U.S. and dove into the rigorous application review process. We'll hear the full bit from Gina Raimondo in just a few moments, and you can also find it on the Yahoo Finance platform. Julie?
Well, Target posted strong results in the fourth quarter, but did strike a cautious tone. As you mentioned, consumer habits are changing, right? They're shifting away from discretionary items. Our Brian Sozzi here with us. He had a chance to catch up with an executive from the company, and he's all over the numbers. So, Saz, what are your takeaways?
Yeah, really interesting quarter here from Target. So a big earnings beat here, Julie and Brad, but they warned on the first quarter and really warned by more than $1 in terms of full year profits. Lots of different moving pieces. Chief amongst those is a more cautious consumer. I put that question, what consumers are buying, what they aren't buying, to Target CFO Michael Fidelki.
Our guests continue to pick Target more and more often. Within that top line performance, we saw a consumer that was feeling the impacts of inflation. Our strongest categories were categories like food and beverage, essentials, and beauty. And we saw slower trends in the categories like apparel and home and hard lines. So for us, that includes electronics and toys and things like that. And so a consumer that's feeling the impacts of inflation. But importantly, they're finding incredible value at Target. They're responding to newness when we have it on the floor pad, and that drove a traffic growth for us in the quarter.
Now, guys, Fidelki told me that Valentine's Day sales went pretty well, and looks like the first quarter has started okay in the context of guidance that was really below consensus, but not a home run quarter from Target. But I think while you're seeing the stock really not fall off a map on this morning, their inventory declined 3% year over year, finally starting to get that ballooning level of inventory that they saw in the back half of last year, finally starting to get that under control. And within this guidance, it sounds like Target is looking for a rebounding consumer into the holiday season of 2023. But again, right now, this is not good old-fashioned Target crushing it because it's selling cheap chic apparel. This is Target dealing with a more cautious, higher income consumer, which appears to be going to Walmart. Let's keep in mind, we heard from Walmart last week here, guys, Walmart US, our same-store sales up over 8% because they gained more shoppers, more high-income shoppers. Those shoppers may be coming from the aisles of Target.
And the big question, too, is where those shoppers are going. Are they going into the physical stores, or are they going increasingly online? And, I'd love to get your read in on that, because they said within this release that they're focused on executing this long-term strategy, continued differentiation through affordability, assortment, ease, and convenience. But you got to think about the number of SKUs that they have on their website, either Target-owned or third-party sellers, and how they're going to continue to woo the consumer in an environment where they have so many options are looking for that value comparison as well.
Yeah, I think you'll hear more from Target on that front and other initiatives. Their Investor Day is in New York City. That's going to kick off around 10:45, 11 a.m. So more to come on that front. We also asked, and Brad, to your point here, if Target has to invest more in lowering prices. I also asked Fidelki about the impact of inflation on that consumer. Take a listen.
If I talk about our discretionary businesses, so apparel, home, and hard lines, we still did $55 billion of business in those categories. And so those categories aren't going to zero anytime soon. We're just seeing a consumer that's making choices as they've seen the persistent inflation in a category like food and beverage, and that's taking a bigger piece of their share of wallet, and that's factoring into their purchase decision.
And Julia, another top executive telling us that disinflation, like the Fed is out there talking about, is not necessarily happening. These companies are still dealing with high levels of inflation in their supply chain, and their customer base still dealing with high levels of inflation, and perhaps going to a Target, not buying those 5 pairs of pants, reinvesting that money that would have went on pants into some cans of soup.
I mean, surely they must be seeing disinflation in certain parts of the business. It would be hard to see that they wouldn't, given what we've seen in things like gasoline prices, fuel prices generally from a year ago, and now apparel. You know, what Target is paying wholesale for apparel, I cannot imagine that it is rising at the same rate as it was a year earlier. But be that as it may, I mean, overall, my impression as I look at this quarter and as I look at the reaction in the share saws is that after the year that Target has had, it feels as though, right, they've taken the lesson away to be more cautious, to under-promise and perhaps over-deliver, and maybe the street is sort of treating the forecast in that way. Not that they're not taking it seriously, but that it's being seen perhaps as overly cautious.
Well, if you're an analyst on the street covering Target, Julie, and you did not see this quarter in guidance coming from Target, you should in fact get a new job, because this was coming at you like a freight train a couple months ago. This is a company that has reported at least 3 challenging quarters in a row, margins under pressure, sales under pressure, traffic under pressure, inventory high. So this quarter was well known, but I do think the big story coming out of this quarter, if you're an investor and you're on the Yahoo Finance platform, you have 2 choices. 1, do you even want to be involved in the retail sector at a time of consumer spending pressure? And then 2, if you are, is it a Walmart? Is it a Target? And I think it's very clear. Walmart quarter, same-store sales in the U.S. up over 8%. Target, same-store sales up 0.7%. It tells you in this environment, Walmart is taking market share, and that is a big win.
All right, we're going to continue to watch shares of Target. We just saw them actually move into positive territory just before the start of trade here. We're still about 23 minutes out, so we'll see how TGT continues to trade going into the beginning of today's session. Yahoo Finance's own Brian Sozzi breaking down all things Target. You're going to hear more from him a little bit later on. Let's switch gears, though, here. We've also been tracking shares of video conferencing platform Zoom. They beat on the top and bottom lines in the latest quarter as new enterprise customer wins helped drive its performance. The company also posted optimistic earnings guidance for the year as it dives more into the AI boom. Joining us now is Zoom CFO Kelly Steckelberg. Kelly, always a pleasure to grab some of your time, get some of the insights and really the catalysts that went into this quarter. If there were a few things that jumped out to you, what would they be?
Well, we were really pleased with our results for FY23 and Q4 as we announced yesterday. So continue to see growth in our enterprise segment of the business, which grew 24% year over year. And then also very strong performance on the bottom line. We had 36% operating margins for Q4, which was well ahead of consensus expectations, which was about 30% operating margins. So very pleased there. And then our gross margins continue to perform as well. We're making this transition from processing our traffic in the cloud into our own data centers, and our gross margins came in at 79.8%. So across the board, very pleased with our results.
Hey, Kelly, it's Julie here. I know some of that margin strength also came because you guys recently did reductions. And I know Eric, your CEO, talked a little bit about that on the call. Obviously, it's a tough thing to do, but that's not something that's going to repeat, hopefully, right? So what does the margin pathway look like from here, and how are you going to continue to expand that?
Yeah, so as we gave FY24 outlook, we guided to continued strong gross margins of 79.5%, again, as we're making these structural changes around our traffic. And then from an operating margin perspective, we guided in a very similar range of 34 to 34.5% for Q1, and for the full year outlook around 36%. And that's as we did make this unfortunate decision to do reductions across the organization, about 15%. but also we're looking at structural changes in our organization to make sure that we support our enterprise customers as efficiently as we can, and also optimizing around the self-service or the online segment of our business, as customers do like to self-serve, and that's a very efficient way for both them and for us.
Kelly, you talked about AI on the call as well, and just wondering for our viewers and for investors out there, what type of timeline should they expect for AI to be an integral part of the existing experience that some Zoom customers do have?
It already is an integral part of our existing business. So we recently launched Zoom Virtual Agent, which is the ability now as part of our contact center, allows customers to use the conversational AI tool to self-serve, and also allows organizations to really easily and efficiently support their customers. We also have great features that are already built in with things like transcription. So if you record a meeting, that takes it into text. Also translation, which is really great for all of our multinational customers. And these are things that have been built into our platform for a while. And then Eric talked about the future, where we will continue to innovate and make all of our experiences on the collaboration platform even more intelligent.
What does that look like exactly, Kelly? Because man, Eric was pumped on the call about AI, wasn't he? He said he's the most excited he's been, I think he said, since 1995. You know, he's an engineer. This was a pivotal time, and now he's saying this is another pivotal time. What can you tell us? What hints can you give us about how you all are going to be integrating this going forward?
Yeah, well, I can tell you, of course, first of all, Eric is a true visionary. And when he gets excited about something, he goes and explores all of the opportunities. We are partnering with OpenAI, as well as he is partnering with many other leaders in this space in the Valley and spending time with them. And so I don't want to share too much or, steal his thunder for the future, but you'll continue to see amazing, advancements and opportunities both in meetings. There are things we're already doing, like Zoom IQ for sales, which allows you to go back and analyze a meeting after the fact. We use it for training internally, for example, to see how many times are our sales reps talking about Zoom Contact Center. You can also use it in real time to give you prompts. Are you asking enough questions? Are you listening? Are you using too many filler words? So these are the ongoing advancements that you're going to continue to see from AI.
Kelly, you talked about deal scrutiny on the call as well, and we know that a lot of companies, some of your customers, are looking across costs to see exactly where they can perhaps minimize or reduce some of their cost structure as well. And that has impacted employees at companies like yours as well at the end of the day, as Julie was mentioning a moment ago. Are headcount reductions in a deal scrutiny type of environment that would be driving growth or driving better deals, is that headcount reduction, do you believe it's done for now?
Well, first, I want to highlight that Zoom is very well positioned, even as we're in an environment of deal scrutiny, as we are highly price competitive and we bring a lot of value to our customers, especially as they continue to consolidate on a platform, which I think is a key theme with all CFOs right now. And you taking and adding in things like Zoom Phone or Contact Center into their already existing meeting platform is a very effective way for them to standardize across their collaboration platform and potentially have savings from getting rid of those on-prem servers that are running some of those legacy systems. And that's how we think we bring a lot of value to our customers and how they can continue to save, even if they're potentially, and expand their share of wallet with Zoom, even if they're potentially having downsizing across their organizations at the same time.
Kelly, great to see you. Thanks for joining us as always. Kelly Stackelberg is CFO of Zoom. Thanks.
Thank you.
Well, today the application process opens for the CHIPS and Science Act, the federal government allocating $39 billion to help chip makers build out more facilities here in the United States. And yesterday I had the chance to speak with U.S. Commerce Secretary Gina Raimondo about that process and what criteria the administration will be using.
We are going to look at each application on its own. And we have very clear national security goals that we need to achieve, which I lay out in the vision paper that we put out today. We need to make sure that we have two big clusters of sophisticated semiconductor manufacturing in the United States. We need to have packaging facilities in the United States. We want to have advanced memory made in the United States. So what we've put out these goals, and then we'll evaluate every application on its own and see, what makes the most sense. The reality is there are only a few companies in the world that can do leading edge chip manufacturing and that can do advanced memory. So we'll look at each of them. There'll be a lot of due diligence. We'll run them through the paces, and then we'll make our decisions.
And there are a couple of chip makers, of course, already that have talked about plans to start construction. Intel, right, of course, Taiwan Semiconductor. And so how will then the grant-making process match up with the plans we've already heard from some of these companies?
Yes, that's a great question. It is possible that a facility that's already been announced would be eligible for these incentives. And I expect that some companies that have already announced projects will receive incentives. The question, again, my job is to make sure that we don't give money to any project that would have happened otherwise. This money is to bring projects to life at the size and scale we need that wouldn't have happened without taxpayer support. And so we're going to evaluate each project on its own and decide what's right for America.
Are companies chomping at the bit here? Are you expecting, once the application process opens, to get a flood of applications?
Time will tell. I'm smiling because we'll have to wait and see. The application is live today, and it's a comprehensive application. We have to, we're stewards of taxpayer money. We have to have lots of information, transparency, accountability. We need financial information for each project from every company. We need to see a workforce plan for each project from each company. It's pretty extensive. So I hope the companies we need to apply do apply, and I'm very confident we'll be successful.
And there is plenty more ahead from the U.S. Commerce Secretary across our programming today. Applications are now open for the CHIPS Act. Companies who want a piece of the $39 billion being allocated can now apply, but firms that win the funds may not be able to buy back stock. You can read all about this in today's morning brief over at the Yahoo Finance homepage, written by our very own Julie Hyman. Let's dive into the act here. So how is this going to impact who might be applying today, Julie?
Well, it's part of a more general narrative, right? Isn't it, from the administration that is sort of anti-share buyback. And so now it's established, and what's developed has been this sort of back and forth between the administration and the business world about this. For example, Chevron, which was targeted in President Biden's State of the Union address, or named by name as being a company in the energy sector that has gotten big profits and is buying back stock, today announced it was expanding its buyback authorization and is now going to be buying back $17.5 billion worth of its own shares per year instead of $15 billion. So there is this sort of tension that has developed. And now the latest battleground for this is indeed the CHIPS Act, and Secretary Raimondo saying that if we give companies money for specifically to build out the semi industry in the United States, they can't turn around and use that money to buy back shares. And there are other conditions attached to this as well. The administration has also talked about, again, more broadly beyond the CHIPS Act, expanding the tax on buybacks to 4% from 1%. We also talked about yesterday, Brad, Warren Buffett firing back against the anti-buyback rhetoric in his annual letter. So again, there's this sort of tension that is going on here. I don't know that there's going to be any legislation that is going to increase those taxes on buybacks, but it's definitely a talking point in Washington right now.
Yeah, and contextually, this is just so significant given the supply and demand imbalance that there was when we had seen 2 years ago, there was so much demand for everything from producing cars. And yes, these chips go into everything from your cars to the telephones that we use and have in our hands on a day in, day out basis. Many people probably sleep next to their phone at this point. All of that considered, for the amount of different environments and technological advancements that require these chips, foundry services are really at the focus here and at the core of making sure that some of the deployed capital brings new capacity online so that we're not running into the same kind of reliance time after time again, and looking at the supply and demand imbalances that did run rampant for several months. And ultimately, even when I was speaking back then with the CEO, or not the CEO, the president of Microsoft, Brad Smith, the same name there, he had said that this might be something that's not resolved for 2 years. And it was interesting to hear at that point in time, back in 2021 even, how long some presidents, executives of major technology companies were baking into their forecasts just how long this may be a lingering issue. And it really does come back to where we're seeing now some of the capital start to be deployed for the bringing online of capacity here too, Julie.
Yeah, I mean, and this is a long-term situation too, right? The administration is focused on a multi-year build-out. The plants that Intel and Taiwan Semi and others are going to be breaking ground on now aren't even going to be completed for a couple of years, let alone starting to really produce chips out into this environment. And as the Commerce Secretary likes to say, the advanced chip making capacity of the US today is zero, right? So that's what the administration is starting to change. Now, in terms of how the administration is allocating these funds and what it wants them to be used for, i.e. not buybacks. I mean, certainly in some cases when private investors put money into particular companies, sometimes they also say we want it to be used for specific things. So I guess it's not that different from that. But just wanted to get the secretary in her own words as to what she said about buybacks.
So the companies are not allowed to use our money, the taxpayer money, for stock buybacks. And also, we will be requiring companies to share with us their research and development plans. And essentially, we want to make sure that their money is being used to increase research and development and innovation, and not to pad their bottom line or do buybacks.
How do you make sure of that? You know, if a company does a buyback after it's received a grant, for example, how do you make sure it's not coming from that part of the balance sheet? Or do you then say, if you do any buybacks at all, we're going to not provide, say, the next tranche of the grant?
It could be that. So we are tranching the money, as you just said, contingent upon their successful completion of milestones. Again, it will really depend. You know, this will really depend. With every grant, you know, these will be multi-billion-dollar grants, so there'll be a extensive agreement as between the government and each one of these companies. And whether it's commitments around buybacks, commitments around the time and scale of the project, commitments around their complying with our export controls, each one of these investment agreements will go into detail around what are the conditions and what are the consequences for non-compliance. In the most extreme examples, we do have the ability given to us by Congress to actually take back the money. So I hope we never have to do that, but there are a lot of tools that we have to keep these companies honest.
Just to zero in on buyback specifically for a moment, this is a topic that's gotten a lot of attention recently from the president himself, who spoke in the State of the Union about increasing the tax on buybacks. Warren Buffett just wrote in his annual investor letter defending buybacks and really using some strong language in defense of buybacks and about people who say that all repurchases are bad all of the time. What's the big problem with buybacks in the eyes of the administration?
You know, I think the big problem is a fewfold. One is that in this case of chips, we need these companies to be investing in their workforce, in innovation, in really doubling down on research and development, which allows them to stay at the cutting edge. And every dollar you put into a buyback is a dollar you're not investing in your workers, worker training, research and development, innovation, et cetera. And so it's just important that this money isn't to make these companies more profitable or to pad their bottom line or to go to increase executive salaries. This money is to allow these companies to be the leading semiconductor companies in the world, and that means investing in their capability. Also, I think from the president's point of view, we've gone through a period in America here where executives and shareholders have done very well relative to workers. And I know the president is, as he says so many times, he has no problem with companies being successful, profitable, and CEOs making a lot of money, but it's time for workers to get their fair share as well.
And you're going to hear more from my conversation with Commerce Secretary Gina Raimondo throughout the day of programming here on Yahoo Finance, including, guess what? Those buybacks aren't the only provisions attached to accepting money as part of the CHIPS Act. There are some child care provisions as well we'll get into. And we'll also hear the Secretary's comments on China and being vigilant with competition with that nation and security as well. Coming up next, though, we got your stock movers and we got the opening bell. We'll take a barometer of the business environment with Workday. Its shares are lower on a conservative forecast. We'll be right back.
Warren Buffett's annual shareholder letter is out. Here are 3 top takeaways from the Yahoo Finance team. First up, a call to action to all humans: start saving money. Buffett says this: "It is those dedicated savers that are forefront in my mind as I write this letter." He adds, "Charlie and I are not stock pickers, we are business pickers, telling people to save money." And maybe they're listening. The U.S. savings rate is now at a 1-year high at about 4.7%. I think Buffett wants to see it even higher. Takeaway number 2, investing school is in no session. Again, no surprise here in the Warren Buffett annual shareholder letter. Buffett noting this, saying, quote, "The lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s as well." Warren Buffett, 92 years old. His longtime partner, Charlie Munger, 99 years old. Warren Buffett saying, if you want to be a successful investor, invest for the long term. No surprise, that's typical Warren Buffett being Warren Buffett. Takeaway number 3 here, a message or messages to all politicians here. Warren Buffett taking some jabs at folks in DC, noting this: Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Interesting take there from Buffett. Buffett also says, really tries to, I think, champion stock repurchases, saying repurchases, those that tell people that repurchases are harmful to shareholders or to the country are particularly beneficial to CEOs. You're listening to either an economic illiterate or a silver-tongued demagogue. So Warren Buffett taking some swings at politicians. What we did not hear in this letter, no succession plan. Warren Buffett and Charlie Munger will be at that May 5th to May 6th annual shareholder meeting in Omaha. Brian Sazzi out.
All right, we're coming up on the opening bell here, so let's take a look at some of the movers that we are watching. And we start with Workday. The company's earnings per share beat, sales beat as well, but it is offering a bit of a conservative outlook. Workday narrowing the range of its subscription revenue guidance for the full year. The shares are down about 1.5%. And that's really what, Brad, most of the analysts were zeroing in on, right? They said basically that things are looking good right now, but there is a little bit of that marginal narrowing of the forecast. So the share's down, but they're not taking that big of a hit.
Yeah, Citi was out with a take on this one, and particularly around Workday. One of the things that they were saying and looking for in relation to earnings here, updates on the management strategy following an appointment to the co-CEO of Carl Eskenbach, as well as the pipeline dynamics for fiscal year 2024. They're also looking for any type of activity on some of their modeling and investments that they're doing in the near term too. So for Workday, one thing that we're continuing to see in extended hours, or at least pre-market here ahead of the open, shares still down by about 1.8%. So investors hoping for a little bit more perhaps, but But at the end of the day, I think for Workday and how they grow out that revenue base and the portfolio clients here, it's going to really come from the management and management leading them through any type of the murky environment that is similar to what Zoom had talked about on their call.
Yeah, there's the opening bell here on this Tuesday morning. I mean, and that comment that you were just making also echoed over by Brett Bracelin over at Piper Sandler, who said the leadership team at Workday does appear to have a steady hand navigating through rough water. So obviously an acknowledgement of the operating environment right now, which is not an easy one, especially if your customers are big enterprises that in some cases are cutting back. So Workday shares, as we noted, a little bit lower. Group 1 ringing the opening bell this morning. And we're not looking at the futures weren't really pointing much of anywhere, to put it simply, right? We're seeing a little bit of a downdraft here for the 3 major averages, but not seeing that big of a hit. And indeed, we were seeing the futures mixed going into the opening bell here today, Brad.
Yeah, it seems like investors still grabbing their bagels or their croissants to get this day started, Julie, here, as we're seeing a little bit over the past 2 days, just this sideways trade, even though we did have some activity yesterday that ultimately petered out. We do see over the past 2 days for this week, still basically flat for the Dow Jones Industrial Average. Ultimately here this morning, though, weighing on that a little bit, it's down by about 0.2%. The Nasdaq Composite over the past 2 days still holding on to gains of about 0.5%, but here out of the gate this morning, tech-heavy average down by about 0.1%, and then the S&P 500 fractional move to the upside to start off this week here, up by about 0.2%, but also down by about 0.2% here to start today's activity. Do want to take a look at some of the sector activity that we're seeing for the S&P 500. 11 sectors, we've got them loaded up for you here on the screen, folks, so you don't have to do any searching yourself. Utilities pulling up the caboose. That's down by about 0.7% there. But leading the pack, you've got energy. That's up by about 0.7%. So just about 4 gainers out of the 11 S&P 500 sectors at this point in time. The Nasdaq 100, you're seeing some mixed activity there, but a lot of red on this screen here. We'll give you a good view of this heat map here. Bringing up the caboose there, you've got ASML that's down by about 2.9% right now, as well as some of the other chip names that we're tracking. AMD is actually down by about 1.25% here, and that is one of the worst performers in the Nasdaq 100 here. However, I was just trying to click on Zoom there a moment ago. All right, so it's not going to highlight for me. But anyway, you see Applied Materials and ticker symbol ZM. Let's just try it one more time. Third time's the charm, maybe not today. All right, we'll come back to it later on, Julie. But that's what we're seeing out of the gate here for some of those mega tech stocks as well here. Just taking a look at Apple, Amazon, Microsoft, Google, all down to start the day, Julie.
Yeah, and Tesla keeps going up ahead of that investor day. I know we're going to be talking much more about that over the next couple of days. Let's talk about another mover, Brad, and this is a surprising one, to me at least, I have to admit. We're talking about Norwegian cruise lines. Like, isn't this supposed to be the golden age of travel? Everybody's getting back out there. Well, Norwegian numbers did not look so great this morning. The company's wider than expected loss, it reported $1.04 versus the 87-cent loss that analysts were anticipating. Revenue did beat estimates, but the company's operating expenses went higher last year due to the resumption of voyages, what that's going to cost. The company also talking about bringing on a couple of new ships. Capacity is going to be going up this year, and it's working on getting those expenses in better control, Brad, and in getting the margins back in expansion mode as well.
Yeah, anytime you're adding extra vessels, of course, to the fleet, that is going to be a major expense there. And it's not like they all get delivered at the same time, too. So it'll be interesting to see what type of impact that has on the financials. But then going forward as well, this has been a massive type of regeneration of demand. And with that, for Norwegian, for Carnival, for any of the other cruise lines as well, Royal Caribbean or Caribbean, however you're pronouncing it at home, this is a major re-engagement period for these companies where they have not been able to benefit, to your point, from some of the, what Hilton has called the golden age of travel in an interview that we had with the president of Hilton. And one of the things that continues to kind of boggle the mind here is where some of those dollars may be flowing into, if not into, some of the cruise line experiences. And so as the experience economy is really foreseeing and continuing to undergo this counter-cyclical recovery, we've heard that from Expedia's Peter Kern. We've heard that from Glenn Fogel at Booking Holdings. We've heard that from Delta CEO Ed Bastian. And so if the travel and accommodations parts of the industry elsewhere are getting some of those dollars, what of those dollars is still left in this near term for the cruise line operators, and how much will they have to continue to spend to really woo the consumer right now as well?
Well, the problem for Norwegian doesn't seem to be getting people on the ships. It seems to be making money off the people on the ships, or making more money off the people on the ships. The company did say that it's expecting to average about 100% occupancy for its first quarter, and it's on track to reach historic levels for the second quarter. Unclear if it'll be still at 100%, but you can't stuff more people on the boat than 100%. So the issue here, it seems to be, is cost. The company's doing this operating efficiency effort, and that'll result, it says, in a decrease about 15% in its adjusted net cruise cost, excluding fuel, for the full year. So, we'll see when that starts to bear fruit and if the numbers start to look better at that point.
Yeah, and I'm just doing a quick search here too, because it's one figure that I meant to look up before the show. But even as we're talking about 100% occupancy, the question, even for the airlines as well right now in this experience economy too, is on what routes, what schedule perhaps as well. If we're applying that to cruise lines, for the comparisons to pre-pandemic, some of them might not still be operating the same full schedule that they had done pre-pandemic right now. So with that in mind, that's of course going to overflow into the amount of customers that are looking to or have to go when there is a certain kind of voyage being able to set sail as well. So just the scheduling. Yeah, exactly. I'm not a huge cruise fan, but anyway, I know some of the terminology there. Also, we got to talk about Olaplex here. Olaplex shares sliding this morning as it saw fourth quarter net sales decline 21.5%. Net sales expected to fall below analyst estimates for fiscal year 2023. And there you're taking a look at some of the actuals versus the estimates here for Olaplex. And it was a mixed bag at the end of the day. EPS that was above expectations by about a cent. However, they did miss on the top line there. So continue to track these shares as well. You were taking a look at this one pre-market as well, Julie.
Yeah, Olaplex really has some significant headwinds here, right? The product came out, and there was just such a fan base for Olaplex, right? It bills itself as being able to rebuild bonds in hair or build bonds in hair. And at first, everybody loved this stuff. And now there is sort of a rising tide of consumer complaints to some degree. There is a lawsuit that says the company's products cause hair loss and other problems. Of course, it is fighting that. But you've just seen a collapse in the shares. This was part of the class of 2021 that I like to talk about, of debuts in the market. In its case, it actually had an initial public offering. It wasn't a SPAC. It wasn't a direct listing. It was an actual IPO. And it came public at $21 a share. And the shares are now trading below $5. So that really tells you what you need to know about the trajectory of this company. They're trying to rebuild things. The CEO, Jui Wong, saying in a statement, our priorities this year are to reset our base, invest in our core, to provide a more powerful platform for growth. So we'll see what that growth ends up looking like this year.
Sounds like a lot of unanswered questions right now if you're for investors. Also, everyone, lots of earnings still to cover today. Warby Parker, J.M. Smucker, as well as Hims and Hers, all in focus following their reports. We're going to be joined by executives from all three companies later on in the show. And coming up next, it's been a tricky February for stocks, and the market commentary isn't adding much optimism. JPM strategists say equities are overvalued, while Citi says the shorts are piling up. Stay tuned. It is the final trading day of the month of February, and investors are now pricing U.S. rates peaking at 5.4% this year. It follows recent economic data that likely reinforces the idea that the Fed will keep on hiking. So, is there more volatility ahead? And where are we? Are we anywhere near a bottom for stocks? Here to discuss is Matt Maley, Miller Tabak Managing Director and Equity Strategist. Matt, always a pleasure to get some of your insights here. As we close out February, what's the setup looking like for March?
Well, it's funny. One thing I will say, it's interesting how we've had in the past, everybody talks about how the October is kind of when we see these big bottoms. But actually, we have seen big bottoms take place in March. The problem is sometimes those don't take place until later in the month and after a fairly big decline. That certainly happened in 2003 and 2009. But after those big bear markets. But my big concern right now is that we're still, at a situation where the market is still overvalued, and certainly not as overvalued as it was, a year ago. But every bear market since World War II has always taken the market to an undervalued level, to at least 15 or actually below 15 times earnings, and we're nowhere near that. And with interest rates continuing to rise again, and of course earnings coming down, earnings estimates coming down for 2023, that I think is going to create some more headwinds as we go through into the month of March.
Hey, Matt, it's Julie here. So to get down to 15, how much further would we have to go to get to those kinds of levels?
Well, the problem is that that's below last year's lows, and that takes us down below 3,500. I'm afraid on the S&P 500, and that's just assuming that and that's assuming that earnings don't fall any further, for earnings estimates that is, and that's a big if. Now some people are calling for the hold up. Right now the consensus is about $220, but a lot of people are looking for it to be lower. So it could be a rougher year than a lot of people are thinking about. And again, I'm not calling for the end of the world here. It's just a situation where valuations got pushed so sky high, at the end of 2021, just like they did at the end of 1999, that it takes longer than usual to get it back down into line with get the market back into line with its underlying valuations. And again, I'm not trying to say that we didn't get as overvalued at the end of 2021 as we did in 2000. So I'm not calling for that kind of a bear market, but I still think we need a bigger decline to again match things with the markets with their underlying fundamental values.
I'm glad you're not calling for the end of the world, because as I remember one of the New York Stock Exchange traders, him saying in my head one time that you can only be right about that end of the world trade once, and do you really want to be? At the end of the day, even if we are to see some strength in certain sectors, if you are sector picking or stock picking, where does there look like there's the most resilience or strength to you right now?
Well, a couple of areas. One is just in the defense aerospace area. We've had this situation where early at the very beginning of the year, a lot of these, the Raytheons and the Lockheeds, even Boeing, which they have their own issues, but those stocks got hit pretty good over the thought that defense spending was going to go down quite a bit. Remember when McCarthy was trying to enough votes to be elected Speaker of the House? Well, that's kind of drifted by the wayside. And if anything, the world's become a more dangerous place in the last month or so. I mean, with what's going on with China and Russia, Ukraine, and we're obviously ramping things up with what we're willing to give Ukraine. The situation between China and Taiwan has not gone away. Israel is still very concerned about what's going on with Iran. So I think defense spending is going to pick up nicely, and if anything, it's going to get higher, not lower. And a lot of these stocks, I think, could look quite good. Even a stock like Textron, TXT, which is a lot cheaper than some of the other names. It's not one you automatically think about when you think about the defense industry, but that's a good play there. So that, and I also think the oil sector is going to, it won't have as good a year as it had last year, but I still think it's a play on the side that it's a group that will outperform as we move through the year.
Hey, Matt, let's talk about large cap tech for a second, because this is the group that's been really vulnerable, right, to rising yields. And it's a group, and we're looking at the heat map of the Nasdaq 100 today. It's a group where we have seen, after that initial rally this year, a lot of stocks sort of rolling over. But the one in the middle has not rolled over as much, or at least it's kind of bounced back here, and that's Tesla that I'm talking about. We have the investor day tomorrow. I know that's when you've been watching. How are you thinking of it as setting up going into that, since it's been a little bit more resilient?
Yeah, it's definitely going to be a bellwether. It's kind of funny because some people really get frustrated with saying that Tesla is a bellwether because, obviously Apple is a much bigger, in terms of, much more product out there. It's in many more homes, et cetera. But its market cap, they obviously compare with one another, number one. But number two, whether we like it or not, it does move with the market. And it has been holding up, as you say. And I'm a little worried that we've seen Microsoft roll over. We've seen Advanced Micro Devices roll over, Taiwan Semiconductor, Google. A lot of these big cap tech names have, again, they've only curled over. I'm not saying that, obviously they haven't fallen out of bed and tested their lows from last year, but they are starting to roll over where Tesla's held up. And I just think that everybody's just so, oh my gosh, Elon Musk, he's going to have, he's going to do his usual magic on the investor day. The stock's going to do better. And then, but we're, like I said, it's holding up near its recent highs, unlike most of the other big cap tech names. What happens then? What happens? Do we get the sell the news reaction to that investor day, or does, for the first time in a long, long time, does Musk not deliver? A lot of people are going to be caught off sides if that's the case. So I'm a little bit worried about Tesla after a double in the last 2 months. How well that can really hold up after we get past this investor day tomorrow.
And then if it is indeed a bellwether, what does that imply for the rest of the market, particularly other large caps that have already rolled over?
Yeah, I mean, again, most of these names. I mean, Google is now getting, or say Alphabet, I guess I should say, is relatively cheap stock. It's price earnings ratio in the mid-teens. But many of these other stocks are still, Apple's still on the expensive side. Microsoft's still on the expensive side of history. And as Tesla comes down, I guess my point is, if we get the individual investors heavily involved in Tesla, both the stock and its options, if they start to throw on the table, I think that'll allow some of the other stocks, those we just talked about, to roll even further, and that could cause the kind of sell-off we have seen many times in March. The good news is, like I said, sometimes March gives us that bottom. I just worry that it's going to be at a level that's significantly lower than we are right now.
Yeah, a painful bottoming process, perhaps. Thanks so much, Matt. Good to catch up with you. Have a great day. Matt Maley is Managing Director and Equity Strategist at Miller Tabak. Thanks. Well, coming up, President Biden's plan to cancel billions of dollars of student debt comes up against a major test at the Supreme Court. It could be a pivotal moment in his presidency. We're going to discuss the various implications next.
The future for millions of Americans with student debt hangs in the balance this morning. The Supreme Court is set to hear oral arguments on the Biden administration's ambitious debt forgiveness program. Here with more is our own Alexis Keenan. Alexis, what do we know so far?
Okay, so the court is going to start hearing arguments in two different cases at 10 o'clock, so just in a few minutes here. And these parties that are arguing, one of the parties is 6 Republican-led states, attorneys general from 6 different Republican states, and also 2 borrowers. What they say is that the Biden student debt relief plan is illegal. They're for different reasons, but let's first talk about just the eligibility real quickly. Now, the plan, it had been offered by the White House last year. It's on hold pending the outcome of these cases. They offered $20,000 in debt cancellation for Pell Grant recipients. These are federal loans distributed by the government, backed by the government. Also, up to $10,000 in debt relief for other federal student loans. Now, there are 43 million eligible borrowers eligible for some level of relief under this plan, some level of forgiveness. Now, to qualify, the modified adjusted gross income has to be under $125,000 for single filers, or under $250,000 per household if you're filing as head of household or as a married couple. Now, these parties who say the plan is illegal, the 6 states and the student borrowers, they're going to first have to get over one hurdle, and that is standing. Can they even bring this suit into the federal court? That's one thing the court's going to decide before it ever even gets possibly to the merits. The states say that they'll be injured if they're not able to carry out the student loans because some of them are invested in student loan plans, and some states have robust companies that are servicers of these student loans, and they don't want to miss out on the interest that would otherwise be paid on those loans. Now, regardless of how the court rules, though, student borrowers are going to have to prepare for repayment because there is a designation in the administration's plans here that after 60 days of resolution of this litigation, go into repayment. Or if there is a resolution, 60 days after that. So worst case scenario, at the end of August. So think August 30th is when these borrowers would have to start repaying. Quickly, I also want to mention the context of who we're talking about and how much money we're talking about. So how do you evaluate if you're for or against this idea? 1 in 5 Americans hold student loans, and that's a total of $1.76 trillion in student loans. 92% of them are federally backed loans. So the estimated cost to U.S. taxpayers, according to the CBO, is $400 billion over 10 years. That's on top of the estimated $200 billion that has already been foregone by the Treasury for the pause in student loan debt that has been during both the Trump administration as well as the Biden administration.
I just know I'm somewhere in there. I'm trying to get out of it right now, Alexis.
Right, you and me.
Yeah, I was going to say a lot of people obviously watching this case really closely. It affects a lot of Americans. Thanks, Alexis. Appreciate it. Well, coming up, we're going to focus in on some earnings, Warby Parker in particular, after that company's first full year as a public company. And we'll have lots more from U.S. Commerce Secretary Gina Raimondo in the next hour. Stay tuned. Well, coming up in the next hour, we're going to hear more from my conversation with U.S. Commerce Secretary Gina Raimondo, including her take on the impact of tariffs on China, as well as trade, as well as U.S. security. She also talks about some other measures that are attached to CHIPS Act funding, including provisions regarding childcare. Not only that, we'll be talking to some CEOs regarding their earnings, including the co-CEOs of Warby Parker, following their numbers out this morning. And also later this afternoon, you're going to hear from Moody's Analytics Chief Economist Mark Zandi. He'll be serving up his thoughts on the state of the American consumer. Keep it right here. Welcome back to Yahoo Finance Live. I'm Julie Hyman along with Brad Smith. We're just getting consumer confidence data from the Conference Board coming in worse than estimated and showing a month-over-month decline. The Conference Board's Consumer Confidence Index falling to 102.9 from a revised 106. This is the February number. So 102.9 for February, 106, which is a revised lower number again for January. It's also much lower than economists had estimated. They had been looking for 108.5 as the reading there on consumer confidence. The present situation index not bad at 152.8, but expectations falling pretty sharply to 69.7 from 76. What do all these numbers mean? Effectively, Americans got less confident in their economic situation in the month of February versus January here, even though they're relatively elevated levels. And it seems like that the lack of confidence has a lot more to do with how they're expecting to feel rather than how they feel today, if that makes sense. In other words, what's the trajectory of the year going to be like versus their economic situation in the moment? And it seems like forward-looking is worse than the current situation right now. So the latest economic data that we've gotten, and Brad, we've gotten a lot of mixed data as of late, haven't we? From strong jobs numbers, the housing market is sort of all over the place, inflation numbers sort of coming back up a little bit, and now we have this to add on to the pile, as it were.
Yeah, plus the earnings data that's rolled in or started to roll in from some of those consumer-facing companies, those who deal in everything from groceries plus the home, electronics, apparel, all of those other categories, and the weaknesses that they're citing here as well. I'll actually pull up some of those retail names. Of course, Target reported earlier today, taking a look at the major averages right now. Not too much movement here today, given some of the activity that we've been seeing over the course of the week. Still down on the day for the Dow Jones Industrial Average. So not a ton of movement on that consumer confidence number particularly, but down by about 0.4%. The Nasdaq Composite holding on to some slight gains here fractionally. That's after we were lower earlier today. We're higher by about 0.2%. And the S&P 500, it's about as flat as it gets, hyper waffling, oscillating in and out of gains and losses as of right now, but flat, about as flat as it gets at this point in time. And since I mentioned retail, let's take a look at some of those retailers as well this morning. And of course, Target was the latest company to report in that capacity. We've already heard from Walmart and what their earnings scenario looked like, as well as the forecast that they issued here. And similarly here with Target, interesting to see them up by about 3%, given some of the weakness that they've already started to cite here going forward. And we're going to hear more from them, their investor day starting out this hour. And so keep a close eye on any commentary to come out from that event. But it's up by about 3.1% for shares of TGT, Target or Target, but Walmart, some of the other retail names, you're seeing them only having some fractional gains or losses in the case of the online e-commerce company Amazon, of course, e-commerce plus, if you will. But Walmart up by about 0.4%, and that's some of the retail environment for you. And then just briefly, let's take a look at the Nasdaq 100, the tech-heavy average there. We were talking about Tesla earlier, of course, a big investor event coming up this week. That is certainly in the minds of investors. Tesla holding on to gains here today of about 0.2% here. And then also keeping close tabs on some of the social media companies. Take a look at Meta Platforms, that move. It's up by about 4.2% here on the day. So keeping a close eye as that company is looking to start to charge people for verification. I'm not sure how many people are going to pay, but we'll see if it works out for them, Julie.
We will see if it works out for them. By the way, we're going to check in with our Brian Sazi on those Target headlines coming out from their investor day. That's coming up a little bit later in the hour, but the company is saying, among other things, it plans $4 to $5 billion in capital expenditures this year, which they say is a somewhat slower pace. We'll be getting into that and some of the other headlines. But getting back to another big story that we're watching today, the Commerce Department opening applications for companies to get funding under the new CHIPS Act. There are details coming out, not just about what are the various provisions for companies to get funding, but also sort of the wider philosophy about the CHIPS Act, this funding, and how it relates to our geopolitical positioning in the world. We talked to U.S. Commerce Secretary Gina Raimondo about all of that.
We are constantly vigilant on this topic. We have to make sure that none of the United States' most cutting-edge technology gets into the hands of the Chinese military. We're very clear-eyed about the fact that in certain areas of technology, the United States is ahead. We're ahead of China. We want to stay ahead of China. We know they're trying to get our technology to advance their military capability. And every time we get information about that happening, we will take action with our export controls. On the tariffs, the U.S. Trade Representative is conducting a 4-year tariff review, looking at all of those tariffs with China. I think her review will be completed this fall. And so we're going to wait and see the results of that. And then, of course, the president will decide what, if any, action he wants to take.
Would you foresee, based upon the findings from the diligence that, as you said, you're doing consistently on military involvement in various industries in China, would you foresee something similar in China as to what has been going on in Russia in terms of sort of expanding out some of the measures that the U.S. is taking, both to look at the military, but also look at other areas of economic security?
I don't see that. We are very focused on being targeted, precise, narrow, and just looking at sophisticated technology China doesn't have where we're ahead, but they want for their military capacity. The United States does a great deal of trade with China. We should continue to do that. It supports a lot of American jobs. And so that we don't want to reduce that, but we do want to be really focused on the technology that we need to be focused on.
And I know the CHIPS Act is just beginning, you're just beginning to put it in place, but I do wonder what other industries you could apply this model to. I was talking to a policy expert today, for example, who talked about the minerals that we use for renewable energy and the other energy industries in the US, and that we get a lot of them from China. So what other industries could we beef up with the help of the federal government in the United States?
I'm not really thinking of it that way. I see this, chips are somewhat unique in that they're the foundation of every other technology, literally big data, medical devices, synthetic biology, AI, quantum, high-end compute, all depends on chips. And we buy 90% of these chips from Taiwan. So this is somewhat unique. And I think this is more, the way we think about it is, we are using this money to make an investment in America's national security in order to achieve specific national security goals, versus as a step forward towards a broader industrial strategy. And so I think it's in everyone's interest that we stay focused in this way, and that we absolutely achieve these national security goals to protect everyone.
That was U.S. Commerce Secretary Gina Raimondo. And as part of the CHIPS Act, there's $50 billion in allocation for research, for plant building, et cetera, in the U.S. $39 billion of that is earmarked for corporations. The remainder is going to go into academic research, STEM programs. And so let's talk a little bit more about that aspect. Neil Thompson is joining us now. He's director of the Future Tech Research Project at MIT, as well as Yahoo Finance's Dan Halley. Neil, as we look at sort of the tech arms race, if you will, and I know in AI in particular, there has been a lot of attention as of late. Kind of where do we stand, and is what the government is doing through the CHIPS Act, is that an effective way to help the U.S. compete or maybe even catch up in some of these areas?
And good morning, nice to talk to you. Yeah, I think this is a very important question. Right now, the United States has, for the first time, really being challenged at the forefront of computing. So for many, many decades, the United States has been leading. And what we've seen in the last 15 or 20 years is trying to really closing that gap. And so I think many of the things that are in the CHIP Act are an incredibly important place to start for making these things. And it's, of course, very important that not only do we pass that, but we also put in that money to make sure that the United States can actually catch up and maintain our lead in a way that we haven't at the moment.
Neil, this is Dan. What kind of areas, do you think are most important when it comes to investing in these kinds of high-tech companies that the government wants to keep ahead of China?
Yeah, so I think here we can think about this on two different fronts. So one is sort of the resources that we're going to be using to do advanced computing, and then the people who are going to be doing that computing. And so on the side of the systems that we're building, some of that is building those advanced chips, and indeed we're thinking very strongly about that. But if we think about, for example, supercomputers, which are the biggest machines that we use for the most complicated simulations and the most complicated scientific computing that we do, the United States has historically had a huge lead in this, and now, depending on the measure you use, China is equal or just above us in terms of the number of supercomputers that they have and they're working with. So, in terms of some of those systems that are at the really cutting edge, we're really now sort of neck and neck, and that's something we need to think about.
And what happens, I guess, if the U.S. does lose its lead, to China, right, or to other countries?
Yeah, so this really matters a lot. And let me give you an example of how we might use advanced computing to give you a sense of how this might work. So some of the biggest supercomputers in the world are owned by oil companies, and they're using it to figure out exactly where to drill. And you can imagine this is a really crucial question because it costs a huge amount to get these drilling platforms set up to drill. And if you drill down and you were wrong and you drilled in the wrong spot, you get what they call a dry well, right? And so that's no good. And so having this better computing means that you're less likely to have that, that means you're more productive. That means that you are making more money. And of course, it also means in this case that you have less environmental damage because you're not drilling in places where there's no oil. So there are lots of advantages that flow here. And if U.S. companies are not the ones who are at the leading edge of that, they're going to lose out on some of those contracts. They're not going to gain their productivity in the way that they have been before.
The federal R&D funding is one thing, at least for this point in time, to ramp the amount of capacity that's necessary to build out foundries and so forth and bring more of that online. But in the future, even further off, do you imagine that there's going to be even more of a passing of a baton ideologically in terms of one side of the aisle versus another in future elections and how they're approaching where we can get ahead of that next wave of necessary chip investments?
Okay, so let me answer what I think, what I'm interpreting in your question, which is that right now we're actually at a very interesting moment in computing where this path that we've been on for decades and decades, what people often call Moore's Law, was really grounded in miniaturization and that making these chips ever smaller. And we're now at a point where we can see the end of that process. And so we're now needing to say, okay, we need to develop this next generation of computers. And they're going to be based on not just miniaturizing our existing CMOS technology, but moving to other ones. And that kind of investment is something that we, is now in the CHIPS Act, and it's really important that we are funding that at an adequate level. It's something that I would argue that, maybe we should have gotten to maybe 10 years ago, but I think it's really important that we're now there and going to be moving into the future with as much of that as we can, because we really need to get there first if we want to reclaim a lead in advanced computing.
Neil, forgive me if you've already kind of addressed this, but just to put kind of a fine point on it here, what we're mostly talking about and the trajectory of U.S. tech development over the last several decades has been that we design here, we develop here, but we don't make here. Does that matter? Is it important for the U.S. to actually make chips, make computers, make technological devices in the United States, physically in the United States?
Yeah, I think so. I think we've seen with some of the supply chain issues that have come up in the last few years that this is a really important question. I also think it's just very important for us to be at the forefront. So there was some very interesting research that was done about a decade ago, and it looked at US companies versus European companies. And what it showed is that half of the difference, so the US companies were more productive, and half of the difference in that productivity was driven by US companies using IT better. And I think the most natural interpretation of that is that US companies were closer to the technology and the frontier of technology, and so we knew how to use it better. And so it's really important that we are at the forefront of those technologies because that manifests in productivity of firms, and of course, as the Secretary was saying earlier, in the competitiveness of US military as well.
Neil, thank you so much. Really interesting perspective. Neil Thompson is director of the Future Tech Research Project at MIT, and of course, our Dan Howley joining for the conversation as well. Thanks. Coming up, Warby Parker's fourth quarter net loss narrows and revenue tops forecast, but does the company have 2020 vision on the rest of the year? We'll discuss with the leadership team next.
Warren Buffett's annual shareholder letter is out. Here are 3 top takeaways from the Yahoo Finance team. First up, a call to action to all humans: start saving money. Buffett says this: "It is those dedicated savers that are our forefront in my mind as I write this letter." He adds, "Charlie and I are not stock pickers, we are business pickers, telling people to save money." And maybe they're listening. The U.S. savings rate is now at a 1-year high at about 4.7%. I think Buffett wants to see it even higher. Takeaway number 2, investing school is in no session. Again, no surprise here in the Warren Buffett annual shareholder letter. Buffett noting this, saying, quote, "The lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s as well." Warren Buffett, 92 years old. His longtime partner, Charlie Munger, 99 years old. Warren Buffett saying, if you want to be a successful investor, invest for the long term. No surprise, that's typical Warren Buffett being Warren Buffett. Takeaway number 3 here, a message or messages to all politicians here. Warren Buffett taking some jabs at folks in DC, noting this: Berkshire also offers some modest protection from runaway inflation. but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Interesting take there from Buffett. Buffett also says, really tries to, I think, champion stock repurchases, saying repurchases, those that tell people that repurchases are harmful to shareholders or to the country are particularly beneficial to CEOs. You're listening to either an economic illiterate or a silver-tongued demagogue. So Warren Buffett taking some swings at politicians. What we did not hear in this letter, no succession plan. Warren Buffett and Charlie Munger will be at that May 5th to May 6th annual shareholder meeting in Omaha. Brian Sozzi out.
Retailers and investors alike perhaps hoping to try before they buy. Eyewear makers Warby Parker out with earnings this morning. The company continues to expand its retail presence in hopes of capitalizing on consumer spending. Did come out with a forecast for the full year that was a little below some analyst estimates. Joining us now to talk more about all of this, Neil Blumenthal, Warby Parker co-founder and co-CEO, and Dave Gilboa, Warby Parker co-founder and co-CEO as well. And Yahoo Finance's Brian Sozzi is joining us here too. Guys, thank you so much for being here. Just first of all, I wanted to get kind of the big picture view as to what you are seeing here. You know, glasses are sort of an interesting item because they are and are not a discretionary item, right? You can buy multiple pairs, but you need at least one in order to see if you are a glasses wearer. So what are you seeing right now? What is it telling you about consumer spending trends?
Well, we're super excited about this category because just the need is so great. By 2050, 50% of the world's population will need glasses. So there is massive need for glasses, for eye exams, for contacts, and we're sort of best positioned to continue to grow within this category. As we look at last year, we grew over 10%, but according to the Vision Council, the category was pretty flat and only grew 0.5%. So even though this category is going to grow for the long run, we do think that we're still in this uncertain moment and people can delay eye exams, can delay glasses, but in general want to save money. And that's why coming to us and, you know, spending $95 on a pair of glasses instead of $400 or $500 makes a lot of sense.
Dave, what needs to happen for that consumer to start buying more aggressively in your stores? Do you have to drop the price point, or you just sit back, wait and see, and the economy, and hopefully the economy turns the corner a bit?
Yeah, so we believe that we offer tremendous value, just like we always have. So our single vision prescription glasses cost $95, the same that they did when we launched back in 2010. Since then, we've expanded our assortment of products and services to include eye exams, contact lenses, progressive lenses, a much broader assortment of options for customers. And we are seeing that people are shopping with us. As Neil mentioned, our growth continues to outpace the category. We are still in a period of abnormal consumer behavior where we saw massive growth in the category in 2021 and then less activity in the category last year. We did see some promising trends around FSA spending towards the end of 2022 that give some indication that there's more predictable, steady behavior returning to the category. But Vision Council is projecting that 2023 is going to be another year of tepid growth in the category, and so we're guiding and proceeding cautiously.
Operating stores is difficult. It usually compresses a lot of margins out there, especially given the disruption that you were able to come into the industry with in that digital first type of touch point with consumers. And so as you continue to open up new stores and march towards that target that we were just sharing with some of our viewers, how do you ensure that you are still maintaining the margins for the business as a whole?
Yeah, it really comes down to discipline, and that's identifying great stores, having an amazing team here. It's focused on real estate, store design, and construction, building stores so that way we can pay them back within a 20-month period, which we continue to be able to do. And when you look at our different cohorts of stores, whether they opened in 2013 or opened in 2021, we continue to have best-in-class payback periods and best-in-class target four-wall margins at 35%. So we feel very confident in our retail expansion, and we find that that's the number one thing that customers want to see from us. When we survey customers, potential customers, why aren't they shopping with Warby Parker yet? They know it's incredible value. They want to have stores near them, given how important convenience is. So we continue to hire and retain great talent, whether it's retail advisors, opticians, or optometrists. And we're seeing that. We're seeing that in our average revenue per customer that continues to increase. We're seeing it in our new business categories like contacts and eye exams, as categories both grew over 80% last year. And a lot of that's due to our store expansion.
I'm glad that you mentioned hiring a lot of great retail workers, opticians, et cetera, because I'm curious how hard it is to do that, right? And you talked about holding the line on the pricing of your glasses, but I'm guessing you might have to be paying some of these folks more. So what does that pressure look like in terms of wages, and whether you've had to raise wages and whether you expect to continue to raise them throughout the year?
Yeah, so we always ensure that we're paying competitive wages for our team. We want to attract the best and the brightest, and we find that we're able to attract and retain some of the most talented people in our category because they want to work for a brand that stands for something, for a mission-driven organization. And we are operating in a competitive job market, just like we always have, but we haven't seen meaningful changes to our ability to attract and retain team members over the course of the last year.
Neil, should investors be thinking?
We do see.
Neil, go ahead.
I was going to mention the one thing that we do see, and we're constantly visiting our stores across the country, is that other retailers, right, have job wanted, help wanted signs in their doors. So the labor market is still tight. The strength of our employer brand enables us to recruit and retain great talent. So we're not experiencing those labor shortages, but it is something for us all to be thinking about from a macro standpoint. And if I had a message to any viewers, call your congressman and let's get Congress to push forward some immigration reform, because we are net negative sort of legal immigration that we need, both high school skilled and low skilled across the country, across categories.
Neil, just going off on a different topic, should investors view you partly as an AI play? That is a buzzword, but I think back to when you launched trying on glasses virtually. What is the evolution of that?
Yeah, we've always leveraged technology. We view ourselves as a tech-enabled lifestyle brand. So we sell a health product that is a fashion accessory. So it's important to have a brand component here, but we've always leveraged technology. 6 months ago, the buzzword was Web3. Now it's AI. We always like to invest in practical technology that's going to make our customers happier and come back and shop with us. So we were the first to launch a true to scale virtual try-on that you're seeing right here. It was first available on our iOS app. We've now launched it on browser to just make it easier for customers to shop with us. We have a virtual vision test that folks can do a vision test remotely and get a prescription for glasses or contacts. So you're going to continue to see us leverage best-in-class technology to make better customer experiences.
A lot of this and the net promoters that are your customers that will tell other people about the strength of the product or the experience, it comes back to the materials that you're able to get for these glasses as well, and even for the contact lens that you're able to produce. How have you been able to kind of navigate any supply chain issues or get the necessary amount of materials to really keep up with some of the demand you're seeing?
Yeah, so we are vertically integrated. We operate 2 of our own production facilities where we cut lenses, insert them into frames, and then ship those glasses directly out to customers. And so the majority of the glasses that we're producing are produced in-house at our facilities in Sloatsburg, New York, and Las Vegas. And that enables us to have faster turnaround times, ensure that quality standards meet our high expectations and our customers' high expectations. And then we work directly to create custom acetates, use the highest quality titanium and other input ingredients into our glasses. And same goes for contacts, where we offer our own brand of contact lenses, Scout, which is a great lens and offers great value. But we also, for our customers who have other brands of contacts that they have been wearing and want to continue to wear, whether that's from AccuView or Alcon or any other manufacturer, we also offer that entire broad assortment. And ensure that our prices on those products are really competitive within the market.
Certainly. That contact lens revenue business that you were discussing, increasing from 4.3% in 2021 to 7.2%. Excellent stuff there, as well as on, of course, the eyeglasses that at least 75% of us on camera right now have. Neil Blumenthal, Warby Parker, Saz just has strong vision. Neil Blumenthal, Warby Parker co-founder and co-CEO, and Dave Gilboa, Warby Parker co-founder and co-CEO, and Yahoo Finance's Brian Sazzi. Thanks so much.
Thanks for having us.
Thank you.
All right, guys, and coming up, software cloud behemoth Oracle got a big boost from NVIDIA last week and could be a major beneficiary from AI overall. So what else should we know? I got you covered with the SWOT. That's next.
Activists are circling Salesforce in a situation that's growing increasingly high stakes for CEO Mark Benioff. Right now, Salesforce is facing down 5 activists, all of whom are demanding better expense management from the cloud giant. Here are the 5 activists. 1, we have Third Point, led by billionaire Dan Loeb. He's previously picked a number of high-profile fights, including at Disney and Shell, and Loeb's the latest to join the Salesforce activist fray, revealing his stake back in February. 2 and 3, ValueAct and Inclusive Capital. It's worth talking about the 2 in tandem because they have something in common. Jeff Ubben, who's the founder of both, and they've already notched a win. Mason Morfitt, ValueAct CEO currently, and Jeff Ubben's handpicked successor, was already named to a seat on Salesforce's board in January. 4th, there's Starboard Value, which got involved in Salesforce back in October. A source tells Yahoo Finance that Jeff Smith's Starboard is disappointed in the cloud giant's cost management, but isn't pushing for Salesforce to divest any of its mega deals, for example Slack, which is on the table for other activist investors. 5th, Elliott Management goes for the jugular. The firm, fronted by Jesse Cohn and Paul Singer, often seeks board representation and even has a private equity unit that is known to bid on targeted companies. Sources tell Yahoo Finance that Elliott's stake is worth billions and that they're going to be pushing for succession planning from Salesforce CEO Benioff and better profit margins. So, where does that leave Salesforce investors right now? We asked Wells Fargo analyst Michael Turin.
I think right now, a lot of things are pointing in a favorable direction for investors around where Salesforce ends up over the next 12 months. The longer question is the harder one to answer on what is the 5-year vision.
Salesforce is reporting earnings Wednesday, so this standoff is heating up.
Let's talk about Oracle now. It remains the quieter alternative for cloud business, maybe. It's not so quiet, though. It may not have the flashier margins of its peers, but it could see upside from AI chatbots, even as the industry remains pressured. Let's get to business class Brad for more on Oracle's position in the cloud infrastructure landscape.
Yeah, thanks so much, Julie. Well, yes, I'm taking a look under the hood here at Oracle this morning. Ticker symbol or ORCL. Yes, ORCL, everyone. It's very clear here. All right, so Oracle here. This company has had a big 2023 thus far. 2 new firms initiating coverage this year. It's up by about 5% year to date. D.A. Davidson, they initiated coverage with a neutral. Mizuho initiated with a buy and a $116 price target. Plus, they also caught 2 upgrades, one from Jefferies, from hold to buy, and one from Piper Sandler with a neutral to overweight upgrade there. And particularly here, one thing that Mizuho stated within this, investors may be underestimating Oracle's potential over the medium term to generate solid top line and cash flow growth and exceed some of the fiscal 2026 targets of $65 billion in revenue. Now, they go on, but here's what I want to get into for our SWOT analysis: the strengths, the weaknesses, the opportunities, and the threats in hitting some of those targets that Mizuho had put out there, as well as the rest of the street is looking for. So in the strengths category, one thing that I'm looking at here is the cloud, and particularly on the cloud, the infrastructure cloud. This is seen as one of the more superior offerings in the market here. Performance, security, and the reliability as well is one thing that constantly gets brought up in some of the net promoter types of conversations from customers, and more broadly in comparison to some of the other offerings that are out there on the street. Now, this was evident, of course, you look through some of the earnings that have come out most recently, past quarter here, cloud revenue, that was up by about 48% here. And even if you strip out Cerner, it still came in up by about 27% for the total cloud revenue growth there. So that a net positive or a strength there for Oracle. However, one of the weaknesses is in this competitive landscape, pricing strategy is one thing that Oracle is going to have to get right. And when you think about that pricing strategy and going up against the other players in this cloud space, that could impact their gross profit margins. Now, they hit 76.1%, and that was the last 12-month figure. That was down, though, from 80%. You think about that a couple years ago is where that stood. And so that is going to be one area to keep a close eye on here in the near term and moving forward. We'll see what the company says on that. When they do report earnings early to mid-March is when those results will be coming out. However, one of the opportunities here, and you may have gleaned some insights just a week ago when NVIDIA reported earnings. They came up in that call because I think about AI, artificial intelligence. Sure, it's a buzzword, but in the company that's been able to create an as a service of anything, why wouldn't we see AI as a service in the future? And for Oracle, already having artificial intelligence or being one of those core CSPs that really is able to already take advantage of or leverage the NVIDIA DGX Cloud, which is their artificial intelligence play. That was a shout out. That was key on the NVIDIA earnings call here. And then additionally, got to talk about one of the threats here. And this is deals on 2 fronts. Number 1, deal scrutiny on the first front, elongated sales cycles. You've heard about this on multiple ERP or cloud collaboration suite type of companies. Workday, this came up on their call. Also came up on the call of a company in Zoom who we spoke to here on Yahoo Finance as well. And particularly what this elongated sales cycle could mean is that you still see some of the deals that they're looking to net out or getting pen to paper and signed off on struggle to fully get across the finish line or take longer to do so. So that could impact some of the results in the near term. But then you also think about the acquire to grow strategy on another side of deal scrutiny. Investors are going to be thinking of this deal scrutiny as how much are you paying within this acquire to grow strategy that has really been popular across the ERP landscape and for some of the broader cloud solutions companies in the market. So that is something that I'm keeping an eye on. Deal scrutiny on 2 fronts as the major threat here as of right now. But moving forward, as of this point in time, it seems like there's still a ton of optimism out on the street with regard to Oracle. We'll see what the company does when they report third quarter results in mid to early March, Julie.
Brad, business class Brad, remind me what ERP stands for? Enterprise Resource Planning. Thank you. Thank you very much. Okay. Now I understand. Okay, thanks so much, Brad. Appreciate it. We're going to take a quick break. When we come back, we're going to speak with Hims and Hers on a fourth quarter that saw the company pass 1 million subscribers. We'll talk scaling up and managing a tricky economy.
Telehealth standout Hims & Hers Health ships prescription medication directly to its customers, including sensitive products such as hair loss treatments and medications for health issues below the belt. The company reported a smaller than expected earnings per share loss while nearly doubling revenue, and it's now looking to reach over $1 billion in revenue by 2025 for more on the path to reaching that goal. Let's get to Hims & Hers Health. Chief Financial Officer Yemi Okupe. Yemi, great to have you here with us and follow up on the conversation that we were having just a few months back about what you're seeing in the business, and particularly here in this most recent quarter, perhaps where you're still seeing some of that strength among the consumers that you engage with.
Absolutely. It's really great to be here, Brad. I think 2022 is definitely a very exciting year for us. We crossed 1 million subscribers, delivered over $525 million of revenue, and achieved our first quarter of adjusted EBITDA profitability. And really, that's the culmination of each of the strategic pillars that we speak about coming together. The trusted brand, our leading technology, providing the ability to deliver personalized products and a high degree of clinical outcomes for our patients and customers. And as a result of that, we really are seeing continued strong momentum with more users coming onto the platform and doing more with us.
And that's something that your CEO, Andrew Dudum, talked about on the call, reaching this sort of inflection point, right, in your growth. So tease out a little bit more, describe to us a little bit more about how the scale that you've reached is going to help grow, as you just alluded to.
Yeah, absolutely. I think it provides a few things. Number one, as more and more consumers come to the platform, they give us a ton of feedback around the things that they want, the types of solutions that are working. As a result of that, we're able to leverage our technology to incorporate that feedback, provide them with the personalized services and cares that they really look for, which in turn results in those customers staying on the platform for longer, as well as adhering to the treatments, which drives better outcomes. And so really, as we continue to get more and more customers onto the platform, we're able to drive more and more personalized solutions, have greater flexibility with the offerings that we're able to offer customers. And so that's what's generating a very powerful flywheel that's resulting in more and more customers coming onto the platform.
As you think about the product roadmap and the solutions that you currently have in market and those that are still set to come, where do you believe the biggest opportunity for the business is?
I think that that's really what excites us. I think while 2022 was an outstanding year, we're even more excited by the future. And that's really a result of the fact that we are really just scratching the surface on many of the conditions that we're in today, as well as many of the conditions that we can be in the future. And so, what you can expect for us in 2023 is to continue to roll out more and more personalized solutions. We just recently rolled out the hard mints product for men's sexual health. That's seen, very, very rapid adoption. And so increasingly, we're going to take the feedback that we're receiving for our customers to deliver the products that they inherently are looking for and want, whether that's in the form of creative formulations or creative form factors. We really have such a large runway ahead of us where when you look at the conditions that we serve today, mental health, sexual health, dermatology, and skin, there's just such a vast opportunity that we truly believe that we are really just scratching the surface of the opportunity.
There is a lot of competition and sort of growing competition in this space. So what kind of moat do you all feel that you have when it comes to these products, particularly when you're, expanding into more dermatological products where there might be some competition that's heating up?
Yeah, I think it's a really great question. I think that healthcare remains one of the largest verticals across the country. And so I think that we'd be naive to believe that we'd be the only players. But we believe that strong execution across each of our strategic pillars will enable us to be a leader in the space. And so when you look at the things that we've built over the last several years, building a trusted brand that removes barriers and enables consumers to have a friendly approach to the health and wellness challenges that they face, leveraging our technology to provide customized and personalized solutions for users, and driving a high degree of clinical excellence, we're confident that the flywheel that we've created will continue to pay dividends for the foreseeable future. And so that's one of the reasons why we were able to lean in and provide additional clarity around what we expect the long-term profile of the business to look like, delivering over $1.2 billion per annum of revenue by 2025, $100 million of EBITDA, on a path towards attractive margins of 20 to 30% in the long term.
So do you believe that pricing is kind of stable for the costs that you have to pass through to consumers right now, or do you believe that there's going to be some moderation in the pricing strategy in the future?
We've actually seen increasing efficiency on the platform. We've been able to pass some of that through to consumers, but what's actually happened over the last several quarters is we've seen gross margins expand as the operation has gotten more and more efficient. We're confident in the value that we provide to consumers across all of those pillars, that they are going to continue to trust the platform and continue to want to interact and engage with us. And so we don't foresee any pricing pressure in the near future.
Yemi, it's always a pleasure to get some of your insights. Check in with the business. Hims and Hers Health Chief Financial Officer, Yemi Okupe. Thanks so much for taking the time.
Great. Thanks a lot, Brett.
Definitely. Take care. Coming up, J.M. Smucker cites cost inflation and supply chain volatility as risks ahead. But is it all doom and gloom? We speak with the company next to digest the latest results. Consumers continue to eat away at those Uncrustables. It's me. J.M. Smucker beat on profit and posted revenue in line with expectations in the third quarter. While updating its EPS outlook, let's welcome in the J.M. Smucker Company CEO, Mark Smucker, along with Yahoo Finance's Brian Sozzi and Brooke DePalma. Okay, so Mark, just take us into the quarter, some of the key catalysts. What really stuck out to you?
Well, thanks for having me, guys. First of all, we had another fantastic quarter. All of our businesses grew up to the tune of 9, 10, 11%. That's coffee, pet, as well as our jam and jelly and Uncrustables business. So we had a really strong quarter, and we did raise the bottom end of our earnings guidance, and just great momentum across all of our brands and continuing to offer consumers great value and our investors growth.
Let's talk a little bit more about that coffee part of your portfolio. Sales there up 11%. What do you think keeps consumers drinking coffee at home? Is it ongoing work from home trends, or are customers perhaps not going out to coffee chains like Starbucks that have raised prices this past year?
It's a little bit of all of that, to be quite honest. 71% of cups consumed are actually consumed at home, and that has not fallen off as we've come out of the pandemic. And our portfolio is so well positioned because we have all of the value spectrum from Folgers, premium coffee like Dunkin', and then our fastest growing coffee brand, Cafe Bustelo, which really is a Latino-based coffee, but is also really appeals to millennials. And so tremendous growth across the whole coffee portfolio.
And to quickly follow up on that, you did note in the call today that you continue to see elevated coffee costs. Where are you now in terms of passing along those price changes? I believe that you're lapping those price changes. And can consumers expect more price increases in the coming quarters?
You know, we have taken our coffee prices up as our physical costs dictate so. And keep in mind that as we manage through elevated costs, we use multiple levers. So not just price increases, list price, but also productivity programs, as well as trade spend and so forth. So making sure that we're prudent about the costs that we pass through to our consumers.
Mark, is this a perfect, and it's Brian here, good to see you again. Is this a perfect environment for the products that you sell? We have an economy slowing down. We have inflation high, people perhaps balking at going out to a restaurant because it costs too much money and trading down to your products. How do you see it?
You know, I think when you look across our portfolio, I already spoke to coffee, but even within pet snacks and our cat food business, we do offer a variety of value propositions. So whether that's premium, if you think about the Milk-Bone brand, premium dental chews versus the base biscuit business, which are both very healthy. So we continue to have great performance, and we do benefit when consumers tend to stay home and eat at home. That clearly benefits our business.
Now, you recently did announce plans to sell part of your pet business for $1.2 billion, but my dog Zoe at home will be super happy to hear that you're investing in dog snacks there. What sort of innovation will bring you to that goal of $1 billion over the next several years?
Sure. You know, what we've decided to divest is largely our dog food business and one of our cat food brands, 9 Lives. And we are intending to sell those businesses to Post Holdings, which is a great home for them. But as you point out, Brooke, you know, we continue to expand our Milk-Bone brand. I just referenced the base biscuit business, but we have long-lasting chews, dental chews, and a number of premiumized biscuits that really appeal to consumers across all of the different snacking needs of their dogs.
Mark, look, I'm a huge Uncrustables fan, but I draw the line somewhere. I love the jelly and peanut butter, of course, and all the different variations. But when it got to the meats, that was too much for me personally. I know I'm not the ideal, or maybe I am the ideal target market. Sorry, a lot of introspection here. But at the end of the day, how is that taking in the market right now once you added in some of the meat options into the Uncrustables sub-brand, if you will?
Yeah, you know, as we launch some of those meat-based bites, what it does for us is validate that the Uncrustables platform can live outside of peanut butter and jelly. But that said, peanut butter and jelly is our bread and butter, and we're going to continue to push that. We just expanded our second facility in Colorado, which is producing more sandwiches, and then building a third plant in Alabama that is really going to meet the demand that we're seeing across the entire market. So no intend to stop growing core peanut butter and jelly.
Well, that is always good to hear, Mark. Look, to us lay people, I do find it interesting that cat food sales continue to be so strong, and you're leaning into this. I mean, you have to be getting researcher on this. Why are cat food sales outperforming dog food sales?
You know, they're not outperforming. I think if you think about the number of pets in total, the number of pets did increase during the pandemic. Cats was no different. And we have put so much resources behind Meow Mix with our Remix campaign. Multiple iterations of that has really brought Meow Mix, you know, the brand that cats ask for by name, back to the forefront in consumers' minds. And that's really supported the business.
I want to quickly take a look at the full year fiscal 2023 outlook. You reaffirmed free cash flow of $550 million. Now, you also noted in the call today that Smucker's still wants acquisitions to play an important role in the growth story here. Do you think that there's any category out there that you think is missing from the Smucker's portfolio right now?
You know, we've been very consistent in our discussion of acquisitions. They have played a huge part in our growth over many years. And we will continue to be interested in that inorganic growth. And that means fleshing out, building out around our existing categories, particularly coffee and dog snacks we're interested in, And then if we do enter new categories, we want to make sure that we're entering a growing category and that we're able to acquire a meaningful position, a leadership position in that category at a reasonable price. So still part of our strategy. We'll continue to look, but nothing to report at this time.
J.M. Smucker Company CEO Mark Smucker, as well as Yahoo Finance's Brian Sozzi and Brooke DePalma. And thank you so much for the time. We appreciate it, as always, diving into some of those uncrustable reports as well.
Thank you, guys.
Definitely. And guys, switching gears here, the Biden administration seeks to make progress in its affordable child care goal through leveraging the government's investment in the semiconductor industry. We're going to discuss that a little bit more on the other side of this.
Well, the Biden administration, as part of the new CHIPS Act allocations to chip makers who are looking for about $40 billion to do R&D and build plants in the United States, they're not just saying companies can't buy back shares after they take the money. They're also attaching other provisions, including, Brad, one having to do with childcare.
That's right. And Yahoo Finance had this chance to speak with U.S. Commerce Secretary Gina Raimondo yesterday on the existing issue of childcare in the U.S. So be sure to stay tuned for the next hour to hear her remarks on what she says companies need to show before receiving any federal subsidies.
Yeah, it's an interesting, this whole CHIPS Act allocation is very interesting with what they are.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Acutho. Here's a look at what I'm watching this morning. A February to forget for the bulls, with all the major indices set to finish in the red. The likes of Target not helping lift sentiment despite a beat on earnings. Have stocks hit a bottom? Well, we'll discuss. And the Supreme Court weighs in on President Biden's student loan debt forgiveness plan. It's a key moment for him ahead of 2024, but is he even going to run? And what could he achieve even if he doesn't? And we'll hear more from the US Commerce Secretary as the CHIPS Act funding rolls out. This hour, her views on conditions for companies taking the money and why childcare is key. But first, let's check in on the major indices as we're 90 minutes into the trading day. A mixed picture here at the moment. We see the Dow there, the only one in the red, off by about 100 points there. The S&P 500 there, just barely eking some gains in positive territory, 0.03% there. The Nasdaq also there, just slightly in the green, they're up about 17 points. And when we look at the sector action within the S&P as we wrap up the month, industrials, the leader, followed by tech, and at the lower end we have utilities and energy, the biggest laggard there, down 7% for the end of February. All right, well, first, getting those trades in. The last day of February might be purely psychological, but comes amid a crowded earnings calendar and economic data pointing to a super hot consumer. Now, the Fed, of course, is set to continue hawkishness, with analysts fearing more hikes are in store as inflation remains strong. Now, markets seem to be taking the Fed's signals to heart, with February ending on a sour note over worries of interest rate tightening. But then comes March Madness. That might still be around the corner, with its big meeting set for the end of March. So let's turn now to some of the analysts as to where the markets are headed. Joining us now, Tony Crescenzi, PIMCO EVP Market Strategist and General Portfolio Manager. Thank you so much for joining me. So as we look at where things stand now, obviously, markets have had a lot to digest this month, and obviously trying to get a gauge on where things are with the Fed and whether or not they should still be fighting it at this point. How would you wrap up where sentiment is now at the end of this month?
Well, the bond market is still quite confident that the Federal Reserve will be ultimately successful in reaching inflation on its target of 2%. This is evident in the market for inflation-protected securities, which are priced for the U.S. Consumer Price Index to average about 2.4% over the next decade. Contrast that against the recent inflation rates, which are over 5%, and clearly there's a vote of confidence in the Fed. You could say perhaps it's a leap of faith, perhaps that inflation expectation of 2.4% is a little bit too low, but it does seem that markets think the Fed is close to being done because it's doing all the things that are necessary to bring the inflation rate down. And last word is that it's respecting the lessons of history given to the Fed, provided, you could say, by episodes in the 60s and 70s, and it's applying those lessons today in the way it conducts its monetary policy, and that's giving the markets lots of confidence.
So, Tony, though, in reality, then, history is telling us that the Fed is almost done. But when you look at the tight labor market, when you look at consumers still spending so robustly, how much should we be relying on history versus perhaps something that we're not quite used to with this current phase?
I think we could expect the Fed to be successful in bringing the inflation rate down. The problem for markets, as you suggest, is the path. It may be gut-wrenching to get there, that last mile, if you will, from getting the inflation rate down, let's say from the 3s to the 2s, could be quite challenging from an economic perspective, because it might mean an increase in the unemployment rate. It might mean tighter financial conditions, in other words, weaker stock prices, et cetera. And so while we should have confidence in the Fed and its formidable power, the path to achieving its objectives could be quite rocky.
And so break that down for us, because I know you mentioned this term, the path to central bank heaven, wondering if the Fed can actually get there as we hear about this hard, soft, or no landings, all these different scenarios. How you talk about your faith in the Fed. What does the path look like as they're rolling things off their balance sheet and the expectations for the Fed rate hikes ahead?
Well, the expression in the bond market is that only hawks, those who are vigilant about inflation, go to central bank heaven. The Jay Powell Fed seems to be hawkish and therefore are headed to central bank heaven. But what does that mean in all practicality? Well, let's think of what's called the proxy Fed funds rate. As you mentioned, the Fed's balance sheet. So the Fed funds rate is headed, the markets think, to around 5.5%. But there's some value that should be placed for the efforts it's taking with its balance sheet. Think of the housing market, the weakness there, near 40% drop in sales. Why? Because mortgage rates have gone up. Why did they go up? Because the Federal Reserve is reducing its holdings of mortgage-backed securities, causing those interest rates to rise. So there is some value in that. So what I'm getting at is, in deciding whether or not the federal funds rate has gone up enough and how much it need go up, you add the Fed funds rate expectation, 5.5%, plus something else. The San Francisco Fed says add another percentage point, roughly, you get a 6.5% funds rate. So what does that mean in terms of equivalence? 6.5 relative to history looks high, but what do we compare it to? Prospective inflation is the answer. Prospective inflation, I suggested, based on tips, is around 2.5%. That puts the so-called real interest rate at around 4 points. Now, in the 60s, it took a 3-point real yield to get the job done in 1969. 1979 to 82, it took 5 points, but that was a 15-year-long problem. The current problem is 2 years long. So it looks like 4 points probably will be enough to eventually get the job done. Final word is we combine this with fiscal tightening, that Uncle Sam isn't spending as much money as before post-pandemic, and of course the tightening of financial conditions. So what I'll call this is the 3 Fs, the Fed, fiscal, and financial conditions combining to get the job done with the so-called long and variable lags that we're accustomed to hearing about.
And Tony, as we look at some of these analyst predictions here, we heard from Bank of America expecting a big slowdown in consumer demand that might be needed to get inflation to the 2% range. You also have Deutsche Bank's Jim Reed really citing the data he's using as saying he's expecting a hard landing given the boom and bust cycle. As you put all of this together and as you look at some of the key events that are coming up in March, how are you laying out the breadcrumbs here as to what you're focusing on when you have so much noise and froth in the markets right now?
Probably the best thing to do is think of so-called initial conditions. How do things look as we go into this? In other words, what kind of shape are we in? Did we exercise enough? Is a way to think about it if you're thinking about fitness. The initial conditions for the U.S. economy are quite good. Number one, the consumer household balance sheets are quite strong. What does that mean? Well, here's one example. Household net worth, according to the Federal Reserve in a quarterly report, is up $40 trillion in the past 5 years, even with the recent drop in stock prices. That's 40% to $140 trillion. That seems like a good cushion that will prevent a hard landing. Secondly, consumers, as you've heard, have high saving balances built up during the pandemic, about $1.5 trillion above the long-term trend line. So that's money that could be spent. And the final word on the consumer is relates to the labor market, income, because we all need income to spend. The job story there looks good with high amounts of job openings that won't change much relative to what could have happened in the past because of demographics. Fast fact, 1957, biggest birth year last century. That means 65 years later, I've got lots of retirements, and this is a wave that lasts through 2030 when the last boomer turns 65 at the December 31st, 2029. So we've got a big retirement wave keeping the supply of labor low, wages up, help boost spending. So think about those initial conditions, and I've left out lots of other initial conditions I could cite, including the low level of inventories in the housing market that will cushion that market against lower prices and therefore help the consumer.
Certainly a lot to keep an eye on there. Thank you for breaking all that down for us. Tony Crescenzi there, PIMCO EVP Market Strategist and General Portfolio Manager. Thank you for your time this morning. All right, coming up, the Supreme Court weighs in on President Biden's debt forgiveness plan. It's a key moment for him ahead of 2024, but is he even going to run? And what could he still achieve even if he doesn't? That's next.
Warren Buffett's annual shareholder letter set to be released on Saturday. The letter and what Buffett is buying, of course, is going to be closely watched by Wall Street, given the billionaire's prior investment success, a heck of a lot of it. Our own Josh Schaefer is here with a breakdown of how Buffett became a $100 billion man. How'd he do it?
So when you take a look at Bloomberg's index, it says that Warren Buffett is worth $106 billion today. Nearly all of that is tied to Berkshire Hathaway stock, which Buffett started buying at less than $10 a share in the early 1960s. Now today, one share of Berkshire Hathaway Class A shares costs about $463,000. But as Buffett's bets have grown bigger, some recent buys really stand out. Up first, Bank of America. Buffett famously piled $5 billion into the stock in 2011, and since then, shares have grown over 400%. Some thought Buffett was late to Apple when he started buying in 2016, but Apple shares have also risen more than 400% since he bought. And more recently, Buffett's been an oil man, dumping billions into Chevron and Occidental, with Chevron shares roughly doubling since Buffett significantly increased his position in late 2020, guys. Okay, so where does Buffett stack up among the billionaires right now? So he's not number one. Okay. We should start there, right? That's Bernard Arnault. He's number one, and then we've got Elon Musk at number two. And what I want to show you guys here, let's take a look at Elon Musk's net worth. See how that chart kind of moves up and down. It looks a little chaotic, right? Elon's still number two, but you can see it almost looks like Tesla's chart, right? To some extent, these billionaires, it's very tagged to what their stock does, right? And then when you look at Mark Zuckerberg's, he also shot up very quickly with Meta, but then see how much he fell as Meta's stock fell. Then when you look at Warren Buffett, the slow process, right? Buy and hold, buy and hold. A little bit more of a steady chart there, and significantly more than Zuckerberg. So that's sort of my biggest takeaway when you compare him to some of the other billionaires and maybe the modern tech billionaire, is Warren Buffett has been able to sustain, while some of these other billionaires are really pegged to one stock, one tech stock that has been a bit more volatile in recent years, while Buffett has been more consistent.
Slow and steady wins the race.
Yeah, indeed.
I always taught you that.
Yahoo Finance's own Josh Schaefer breaking down all things the Oracle of Omaha. Buffy the stock market slayer here on the day. Thanks so much, Josh.
Oral arguments are underway at the Supreme Court determining the future of student debt payments for the more than 40 million Americans. Yahoo Finance's Alexis Keenan joins us with the latest. Hey, Alexis.
Hey, Rochelle. So yes, arguments are already underway in these two cases. They're cases where 6 Republican-led states and also 2 borrowers, student loan borrowers that do have student loan debt, they're challenging the Biden administration's plan to forgive $400 billion, that's the cost at least to U.S. taxpayers of student loans. Now, the parties, they say that the plan is illegal and should not be able to be carried out. And so far in these arguments, the justices across the ideological spectrum, they're asking some questions and are really skeptical about a few things. First is the scope of the law, and the one that's at issue here is the HEROES Act. And what the justices are asking is, did Congress mean to give the Education Secretary and the executive branch here this broad authority to waive student loans, or did they simply mean to give enough authority in the law to modify student loan debt? Also, they're asking about a Supreme Court created legal concept, and that's called the Major Questions Doctrine. And what it does is it's invoked when a federal agency takes an action of, quote, vast economic and political significance. And the justices here are asking, well, isn't $400 billion an amount that should be addressed by the Major Questions Doctrine, because that is a sweeping large amount of spending by the executive branch. They're also asking about standing and whether the parties here even have the right to bring these federal lawsuits. And standing is about whether there's actually a particularized harm that either the states or the borrowers would suffer if this program is rolled out. And finally, also questions about just general fairness of this rule. One of the questions was about how do we make it fair to those who have already paid off their student loans? Those borrowers should be not discriminated perhaps against. And also, what about the taxpayers who never took loans at all? Should they be on the hook for this kind of bill? Look, the justices, the way they're phrasing it is, how do we address the fact that this is nearly $500 billion that the government is looking to spend without some express, or at least more express, kind of mandate from Congress? They're saying, should Congress be stepping in here? Rochelle?
That's a tough one, obviously, with the checks and balances and so much at stake for so many Americans with student loan debt. Great stuff there. Thank you so much, Alexis Keenan. Well, another question lingering in Washington. Will President Biden run for re-election in 2024? Now, sitting out a second term could create more opportunities for the 80-year-old leader. Here's Yahoo Finance's Rick Newman with more on that. So, Rick, an interesting proposition here in case he doesn't run.
Yeah, what people kind of forget is that if you are a politician, and especially a president who is not running for re-election, you can take more risks politically because you don't have to pander for votes. It's quite simple. So Biden has not yet said, yes, he is running for re-election, and some stories have been surfacing the last couple of weeks that maybe he's having second thoughts about that. Let's say he does not run for re-election. That would actually give Biden the ability to tell voters the truth about things that, important things that politicians are really just circling around at the moment. I mean, big ones are Medicare and Social Security. We're getting new data from the Congressional Budget Office. These programs are both going to start running short of money in 5 to 10 years. There's this big rhetorical battle that Biden is saying, oh, Republicans want to cut these programs, and Republicans saying not at all, but the programs are way too expensive. And the fact is that we are going to have benefit cuts to Social Security and Medicare, and we are also going to have tax hikes, which is what Biden wants to do in order to stabilize those programs. So nobody is telling voters that. And let's say Biden doesn't run for re-election. He could say, look, folks, I'm going to level with you about all these different problems. The same thing is true with the gigantic federal debt, which is $31 trillion and rising soon to $40 trillion and then $50 trillion. We have too many government benefits and our taxes are too low. And there's not a single politician out there who seems willing to say that. So if Biden doesn't run, he would be in a better position to give voters these uncomfortable messages, which, of course, they don't want to hear.
So then as we dig deeper into this, Republicans seeking for President Biden to cut Medicare, what can you tell us about that? What is it that they want to see happen?
Well, so the standoff over the debt ceiling is that Republicans say they are not going to agree to raise the debt ceiling unless there are spending cuts. But Republicans won't say what spending cuts they want. And you can only look where the money is. So because Biden has said, oh, that means you want to cut Medicare and Social Security, Republicans have said, nope, we're not going to cut that. They've also said we're not going to cut defense. So what is left to cut? And Biden is going to give a speech today where he's going to say, oh, well, here's what Republicans want to cut. They want to cut Medicaid. That is the health program for the poor that all states participate in. And oh, by the way, they also want to repeal Obamacare again, try to do that again. And that is the way they're going to try to cut spending. Now, Republicans have not yet said that is what they want to do. But what the Biden administration is doing is saying, well, these are the things they've tried to cut before. So when they finally do have to show us their spending cuts, this is probably what they're going to go after. So this is just a big rhetorical battle that is going to go on all the way until we get to the point where they finally do raise the debt ceiling, which is almost certainly going to happen. But how ugly is it going to get till that happens? We've been talking about that a lot already, and we will continue to talk about that during the next several months.
Certainly reminds us of all the things that are wrapped up in that debt ceiling discussion. Great stuff there. Rick Newman, thank you so much for that update. All right, coming up, the auto space is clearly in a transitional period, and Ford has been facing the heat as much as anyone lately. But does it have the fuel to make it through to its EV goals? That's next.
Warren Buffett's annual shareholder letter is out. Here are 3 top takeaways from the Yahoo Finance team. First up, a call to action to all humans: start saving money. Buffett says this: it is those dedicated savers that are forefront in my mind as I write this letter. He adds, Charlie and I are not stock pickers, we are business pickers, telling people to save money. And maybe they're listening. The U.S. savings rate is now at a 1-year high at about 4.7%. I think Buffett wants to see it even higher. Takeaway number 2, investing school is in no session. Again, no surprise here in the Warren Buffett annual shareholder letter. Buffett noting this, saying, quote, the lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s as well. Warren Buffett, 92 years old. His longtime partner, Charlie Munger, 99 years old. Warren Buffett saying, if you want to be a successful investor, invest for the long term. No surprise, that's typical Warren Buffett being Warren Buffett. Takeaway number 3 here, a message or messages to all politicians here. Warren Buffett taking some jabs at folks in D.C., noting this: Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Interesting take there from Buffett. Buffett also says, really tries to, I think, champion stock repurchases, saying repurchases, those that tell people that repurchases are harmful to shareholders or to the country are particularly beneficial to CEOs. You're listening to either an economic illiterate or a silver-tongued demagogue. So Warren Buffett taking some swings at politicians. What we did not hear in this letter, no succession plan. Warren Buffett and Charlie Munger will be at that May 5th to May 6th annual shareholder meeting in Omaha. Brian Sozzi out.
Ford is driving on a rocky road from production halts to a cost disadvantage of $7 to $8 billion. Now, the automaker continues on its route towards the EV revolution, but does Ford have the fuel to make it through to its EV goals? Here to discuss this and more is Garrett Nelson, CFRA VP and equity analyst, along with Yahoo Finance's own Pras Subramanian. Thank you for joining me, Garrett. So we know you have a buy rating on Ford, a 12-month price target of $17. It does have a lot of pros going for it. Valuation, demand, reinstated its dividends. But when you look at things like cost, when you look at things like the operational issues, what is going to get it to that price target?
Yeah, thanks for having me. You know, Ford has quietly become the second best-selling U.S. EV manufacturer. They're a distant second to Tesla, but still, they've done a lot better than many of their peers. And so, you know, we think that, you know, that's a big part of the growth story going forward. We know the F-150 Lightning electric pickup is available. The reservation count is north of 200,000 units for that vehicle. And they've had a lot of success with the Mustang Mach-E and other EVs that they've put out. So, but still, there's a lot of work to be done. As you noted, you know, Jim Farley took the CEO reins almost 2.5 years ago, and I think there's some frustration that they're not really turning the corner as fast as a lot of investors would like. They did double their dividend last year. The stock is yielding, you know, roughly 6% here on that dividend, but I think there's still a lot of work to be done. You know, when you look at Ford's global footprint and their employee count, we think there's still a lot of room for improvement. And so, you know, Farley really has his work cut out for him still.
Hey, Garrett. So, you know, Ford last 2 quarters were a little sort of disappointing for investors. Had some issues here with the EV transformation. They're really going hard with the splitting of the company up. You know, the Ford Lightning with some issues with the batteries and their ongoing recall issues with other vehicles. Is the transformation sort of stalling there for the company? Is it more of a short-term thing, or are there long-term issues here?
Yeah, we think it's more of a short-term thing. You know, Ford's not the only one that's had battery issues. In fact, we put out a report a couple weeks ago, you know, looking at the really frustratingly slow pace of EV production ramp up of the likes of, you know, General Motors has had problems with their battery for the Bolt. Now Ford's having problems with the F-150 Lightning. But you look at some of the smaller EV manufacturers like Lucid and Rivian, you know, their production ramp-ups have been very disappointing. And so, you know, we think it's more of a near-term problem. But, you know, really the only automaker, in our view, in the U.S. that has mastered, you know, the mass market EV production is Tesla, really. They really have it down to a science. And it's going to be, we think, a bumpy road for a lot of the traditional automakers who, of course, you know, have been producing internal combustion engine vehicles for many decades, but you know, EVs, that's a whole new ball game, and so there's a lot of adjustments. There's going to be a lot of growing pains, we think.
You mentioned Jim Farley on the job for about 2.5 years now in the CEO seat. You know, he's an operator, he's a car guy. Wall Street applauded his sort of promotion to the CEO role. Is he still the right guy for the job, given what Ford is doing? This is a big transformation and a huge turn for the business.
I think you hit the nail on the head. I mean, that's the question everyone is asking. There's been a lot of frustration. The stock price, you know, after a big run up, you know, really in the year or so after he took the reins, has really stalled. You know, part of it was because Ford's production and earnings were rebounding from the depths of COVID in 2020. But, you know, now is really, you know, he's going to really have to show some improvement here. You know, part of the plan is to separate the electric business from the internal combustion engine vehicle business. We do think they're following the right strategy by taking a more balanced approach towards EV growth and really focusing on building excitement surrounding individual EV models, as opposed to setting a date in the future which in which they're going to be all electric. We think the balanced approach is the right one. Just given the fact that EVs still accounted for less than 6% of all U.S. new vehicle sales last year. Clearly, EVs are the future of the industry, but growth is going to take several years.
And as we look at Europe, because they did set targets there in terms of when they want to be all electric, they've also announced about 3,000 job cuts. They're really trying to streamline some of the range of the products they have out there as well. What else do you think is going to make Ford more competitive in the EV space?
Yeah, it's really just building excitement surrounding individual models. They want to be able to offer electric versions of certain models, such as the Bronco hybrid version and then all gas version. So we think giving consumers those kinds of choices as far as what they want to purchase is really going to be beneficial to them. So but he took over at a time where we felt there was a lot of low-hanging fruit in terms of operational improvement that they could make. He's made some progress, but I think a lot of investors didn't have an appreciation for how difficult, what a massive global footprint that Ford has, and really improvement is going to have to be made across all geographies, and so I think after 2.5 years, a lot of investors are thinking they would be farther along. So really, there's a lot of pressure on Farley, and he's going to really have to show some execution here in the coming quarters.
Garrett, you mentioned Tesla, and this is a company that Ford is trying to emulate here. Tomorrow, Tesla has their big Investor Day event in Texas. What are your sort of high-level thoughts on what we can expect to see, and what are you sort of bullish on there?
Yeah, we put a note out this morning on this. We think there's both near-term issues and long-term issues there. Near term, it's going to be the rebound in demand following the price cuts. Has demand remained strong? In the weeks since they cut pricing in January. As far as any new products, more specific details as far as first production and deliveries of the Cybertruck. How quickly can they ramp up volumes? We know the backlog of that model is the highest of any forthcoming EV by a wide margin. The reservation count is rumored to be north of 1.7 million units. So, and then longer term, it's how are they going to execute as far as this very ambitious production growth goal to go from the 500,000 units that they sold in 2020 to 20 million units by 2030. That's 40 times growth. It would make them the largest auto manufacturer in the world by a wide margin. But to do that, I know there's been a lot of chatter regarding them potentially unveiling a mass market EV, a compact vehicle, sort of a coupe or hatchback type lower priced vehicle. So I think there's some anticipation that might happen. What we do know is that in the past, leading up to these investor events that Tesla has had, the stock price has typically risen, and then afterwards there's been sort of a sell the news reaction typically. So and sure enough, right. That's what we've seen with Tesla up almost 70% year to date heading into today.
And certainly helped him regain his richest person in the world throne. And we're looking forward to hearing more about the Master Plan 3 as well. A big thank you there to Garrett Nelson, CFRA VP and Equity Analyst, and our very own Pras Subramanian. Thank you both for joining me. All right, coming up, the European Union's top regulators haven't been shy about taking on big tech. But according to fresh reports, Apple could be facing even more heat. Those details next. EU getting to the core of its antitrust suit against Apple with a new, more narrow focus on the tech giant's App Store rules. Some good news for Cupertino, the EU dropping a key part of its case about payments. Here with more, Yahoo Finance's Dan Howley. Hey, Dan.
That's right, Rochelle. This is kind of good news and kind of bad news for Apple. Basically, what they're doing here is, as you said, narrowing the focus of their investigation, mostly now looking at how Apple prevents companies from mentioning to users in the App Store that you can get their apps for cheaper online. So, for instance, say with Twitter Blue, you can get it for a reduced price through the web rather than on the App Store, and that's just because of that 30 to 15% fee that Apple charges app developers. So now the EU is looking at this. It's bad news because it means that people will likely go for the cheaper option, especially when it comes to services they already know, perhaps Spotify, which basically helped kickstart this effort in the EU against Apple. If they already know the service, why not just go there and sign up for a cheaper subscription? The good news for Apple is that it doesn't have to do with some of the other charges that were pending, such as preventing users from downloading apps from third parties, though that could change, or will change rather, in the future.
So then, as you mentioned some of those charges that the EU dropped against them, why were they dropped?
Yeah, I think it's just a matter of this being an easier hit against Apple. It basically, they'll say that if you download an app from a third party, they can't guarantee the security of that. But the Digital Markets Act, which is going into effect in the EU in 2024, which is when it'll actually fully be enforced, means that Apple will have to allow third-party downloads anyway. So what they're going to do is allow third-party app stores outside of the standard app store that you have on your iPhone now. So that means that you'll be able to get apps from other places, not just Apple. Now, you could argue that, well, that's riskier, and sure, it could be, and Apple also will likely make it easier for you to download apps through the App Store than it is for third-party app developers. And having to download a third-party app means having to download an app, and that adds that kind of friction that consumers don't really like. So it's unlikely to have too large of an impact on Apple's bottom line. So the fact, though, that the Digital Markets Act is going into effect, period, means that a large chunk of the complaint against Apple has already been kind of dealt with. So now it's just whether Apple can tell people, no, you can't advertise your app for cheaper. And really, when it comes down to it, it doesn't seem to be that big of an issue to help consumers in any way by not allowing them to see cheaper prices. So now this is where the EU is pointing, and we'll see if it works out. Apple says they're going to respond to this, but it's a good news, bad news, not great news kind of situation for Apple, really.
Indeed, especially the narrower scope at least takes some things off the table, at least some of the pressure there, but obviously that scrutiny not going away anytime soon. Dan Howley, thanks so much. All right, well, from iPhones to chip makers now. Applications opening for companies to receive CHIPS Act funding, but it comes with stipulations for businesses. We chatted with US Commerce Secretary Gina Raimondo about the broader implications behind childcare requirements in the CHIPS Act. Joining us, Yahoo Finance's Julie Hyman. Hey, Julie.
Hey there, Rochelle. Yes, I talked to Commerce Secretary Raimondo yesterday, and we talked about some of those stipulations, some of those conditions that are attached to receiving the money. Among them, that these companies are not supposed to use the funds to buy back their own shares, and also that if they are using them to open plants, there has to be childcare available for employees. Listen to what Secretary Raimondo had to say.
So as part of the application, and before any company receives any of this money, they have to show us and have approved a workforce plan. And as part of that, we want to see how they plan to provide affordable childcare, or not so much that they would provide it, but that it would be accessible and available to people that are building the facility, construction workers, as well as people who work in the facility. And the reason for that is quite simply, we're in a tight labor market. There's a historically low unemployment rate, particularly in the construction field. Each one of these facilities requires 6,000 or 7,000 construction workers. The reality is it's not going to happen unless women are working on those sites and in those facilities. And that won't happen unless there's reasonable childcare. So It's not, let me be clear. We don't want any company to do anything that's not in their best commercial interest. But we also know they won't be successful unless they have the talent to do the job. And that includes women.
Yeah, I mean, this is something you and I have talked about before, and it would seem to be fairly commonsensical, right? That you provide or you make sure that certain measures are provided to get the qualified people in. What does affordable childcare mean? What are some of the parameters you're putting around this?
That'll be different for every company in every geography and based upon their needs. And that's why these are really individualized investment grants. So we are going to work with each company. Tell us about the size and scale of your facility, where you want to put that facility, which suppliers do you need near you in order for this to be successful? How do you plan to work in the local labor market to attract the labor that you need to do the job? And then in the case of childcare, it just depends. Some places there's no supply of childcare. It's a supply problem. In other places, it's a cost issue. So the point here is we don't want to impose any, predetermined requirements on any company. We want to work in partnership with these companies to make sure they're successful in the project.
And so, it was interesting talking about the sort of individualized plans they're talking about for each.
So I think it's interesting because with a lot of these job creating initiatives that come out, that's the piece that gets missed out, the support aspect of it, what workers actually need to be able to take advantage of these jobs. How surprising was it to hear that talked about here when we don't typically hear that?
It was somewhat surprising, but not necessarily surprising coming from the Commerce Secretary. As you heard me say in the interview, this is an issue that she has talked about before, women in the workforce providing support through childcare. And again, it would seem to be a pretty clear business imperative that businesses have incentives to do this, and yet they so frequently don't. So it is interesting here, and what is different is seeing the administration sort of push its agenda because it has this big carrot to offer, right, in the form of funding for the CHIPS Act in order to try to get this through. Now, will that then also incentivize companies that are not receiving the funding if they see that it is a successful way, for example, for companies to recruit workers? Maybe. I imagine that that's part of the hope as well, that in a difficult in what is still a difficult labor environment for employers to attract workers, it's not just about offering them more money. It's about the broader support that they can offer them as well. So it looks like that's what the administration is trying to do here.
And she did seem to sort of pre-address some of the pushback that some companies might say they can't afford it. And she did really stress that this isn't about a hardship for companies, that it is sort of a case-by-case basis as to what some of these companies can afford and the supply issues as well.
To be
Do you
clear,
think there's going to be much pushback?
To be clear, and just because I think it can be a little misunderstood here, they are not requiring the companies to pay for it, right? The companies themselves do not have to provide the child care. But if the plant is being built in a remote area, for example, they have to ensure that affordable childcare is available. Now, in some cases, will that end up being that they are going to have to provide some of the financial support, for example? Perhaps, but that's not explicitly what they are stipulating in these plans. So just to be clear there, but yes, it definitely, it felt like there is a little bit of, pushback perhaps anticipated. Listen, you could say, devil's advocate for a moment, if you want to be able to buy back your shares with this money, if you want to not have to do this with childcare, you don't apply for the funds, right? So right. I think it's interesting, just because it's the federal government, if I'm any private investor and I'm investing in a company, can I say, listen, these are the strings with which my money comes attached, right? I think that is something that happens, but because it is the administration, there are sort of other connotations here. So we'll see what kind of pushback it gets.
And that's that distinction. That is a different lens that we do view when it is something coming from the federal government versus, say, a publicly traded company. So definitely worth keeping in mind. Julie Hyman, thank you so much for that interview. All right, well, switching gears to the state of the housing market. We've been seeing conflicting data with mortgage rates up, mortgage demand fell last week. But looking at month-to-month data, pending home sales and new home sales both saw a bump. Here to help us sort through all of this is Todd Henderson, DWS Group Global Head of Global Real Estate. Thank you for joining me this morning. So as we're trying to get a gauge on what's happening with the real estate market, real estate, the third worst performing S&P sector for the month. But how much of this is about rising interest rates versus, say, other factors at play?
Well, thank you for having me. It's nice to be here today. The underlying fundamentals of real estate are quite strong. What has happened in the real estate industry over the last year, we really had a tale of two markets. The first half of the market for the private real estate sector performed very strongly, whereas the second half of the year, we saw the market capitulate to what was occurring with the Fed's movement of interest rates. So what we've seen is a fallback in pricing, but what has endured are the fundamentals. We are sitting here today with some of the strongest underlying fundamentals in 3 of the 4 major sectors that we've ever seen. Vacancies, we finished the year in 2022 at 5.3% vacant, which was the lowest vacancy on record since keeping records in 1988. In addition to that, we saw the highest income growth for the real estate market for the year, 7.9% that we'd seen historically, except for a small time during the recovery from the pandemic. So what we're seeing here is market pricing changing as a result of the cost of capital changing, but still strong underlying fundamentals excluding the office sector.
So as we look at the 4 sectors, you mentioned office there, you also have residential, industrial, and retail as well. Talk about residential in terms of where you see house prices going, and perhaps you also mentioned the role of millennials in your notes and how they're going to be affecting the housing outlook.
Yeah, so millennials have been a big part of the story over the last year as housing formation increased materially over the trend. I think that will continue. But housing prices are a bit challenged as a result of the cost associated with owning homes, in particular, the cost of mortgage financing, which we think bodes well for the rental market, both the traditional multifamily rental market as well as the single-family rental market. We have seen, however, some slowing, and I would call it more normalization, frankly, of demand in the rental market here as consumers, as renters, as homeowners are starting to feel the cost of increased goods and the cost of increased mortgages around the housing market.
And I want to ask you about the increase that we've seen in cash buyers. Bloomberg reporting that over 50% of the 13 cities that they were looking at in the Southeast, which we know was a hot market, especially during the pandemic, but seeing less institutional investors. What are you seeing in terms of the balance between, your regular, person trying to buy a house versus some of these institutional investors?
Yeah, so it stands to reason that if you think that mortgage rates are up temporarily, that if you can afford to buy a home unleveraged, you would buy a home unleveraged and then leverage it at a later date at the point in time when financing costs are significantly less. The institutional investor today is really historically has looked at real estate more as an income and diversification play and has been lower leveraged and sometimes no more than 15 to 20% leverage total in their underlying core real estate portfolios. So leverage has less of an impact on them in terms of their ability to participate in the market, but it obviously has an impact on the cost of capital and therefore the swings that we would see in the overall values associated with the real estate market. And as a result, flows have reversed in the real estate market from the first half of last year, where flows were still coming into the market, to the second half of last year, where flows were coming out of the market. That was partially due and mainly due to the performance of real estate relative to the other asset classes. The institutional market has become over allocated to real estate relative to their stated targets because of the performance of real estate relative to the other asset classes.
And just quickly, I wanted to get your top takeaways. Office and retail. We know you're bullish on retail and bullish on office, but overseas as well.
Yeah, so I would say that we're bullish on certain sectors of or subsectors of the retail market. We like the neighborhood shopping center market. Necessity-based retail, we think has a very has a place in the portfolio today. That's for a couple of reasons. One, we've seen very strong performance in grocery-anchored neighborhood centers. The vacancy levels are lower than they've been in 17 years, and you see a lot of service-oriented retail in neighborhood shopping centers, which is very difficult to disintermediate through e-commerce. On the office side is, for the most part, is very challenged, but you can't necessarily eliminate all of the office market or all office buildings from a portfolio. There are areas with strong job growth and strong population growth, and the best-in-class office buildings within those markets are still performing reasonably well. But it is clearly the worst performing office or worst performing sector out of the four currently, and we expect that to continue. In the U.S., we have vacancies today that are high as they've been since the 1990s S&L crisis, and we expect throughout the year that they will eclipse the S&L crisis vacancies and hit peaks for vacancy. As a result of, one, it is the most correlated to the business cycle, and as we head into a slower and slowing business cycle, we expect it to underperform. Right. And then obviously the hybrid working or work from home environment has an impact as well on demand for office. So we do expect office to trail the other three major sectors, and we expect to be underweight, but where we will own office is in, again, those cities and areas that have strong job and population growth, and will own the best-in-class office buildings in those locations.
It's certainly important not to, look at the real estate as one monolith. Certainly a lot at play here, and as you mentioned, that weakness that you're seeing in the office sector. A big thank you there. DWS Group Co-Head of Global Real Estate, Todd Henderson. Thank you so much. Right, coming up, last year's crypto meltdown caused chaos for investors and businesses across the globe. But one question remains. Where have all the crypto bros gone? We find out next.
Activists are circling Salesforce in a situation that's growing increasingly high stakes for CEO Mark Benioff. Right now, Salesforce is facing down 5 activists, all of whom are demanding better expense management from the cloud giant. Here are the 5 activists. 1, we have Third Point, led by billionaire Dan Loeb. He's previously picked a number of high-profile fights, including at Disney and Shell, and Loeb's the latest to join the Salesforce activist fray, revealing his stake back in February. 2 and 3, Value Act and Inclusive Capital. It's worth talking about the two in tandem because they have something in common. Jeff Ubben, who's the founder of both, and they've already notched a win. Mason Morfitt, Value Act CEO currently, and Jeff Ubben's handpicked successor, was already named to a seat on Salesforce's board in January. 4th, there's Starboard Value, which got involved in Salesforce back in October. A source tells Yahoo Finance that Jeff Smith's Starboard is disappointed in the cloud giant's cost management, but isn't pushing for Salesforce to divest any of its mega deals, for example Slack, which is on the table for other activist investors. 5th, Elliott Management goes for the jugular. The firm, fronted by Jesse Cohn and Paul Singer, often seeks board representation and even has a private equity unit that is known to bid on targeted companies. Sources tell Yahoo Finance that Elliott's stake is worth billions and that they're going to be pushing for succession planning from Salesforce CEO Benioff and better profit margins. So, where does that leave Salesforce investors right now? We asked Wells Fargo analyst Michael Turin.
I think right now, a lot of things are pointing in a favorable direction for investors around where Salesforce ends up over the next 12 months. The longer question is the harder one to answer on what is the 5-year vision.
Salesforce is reporting earnings Wednesday, so this standoff is heating up.
Where have all the crypto bros gone? Now, the industry already cut more than 2,000 jobs in just the first 2 months of 2023. But according to workforce intelligence company Revelio Labs, attrition from crypto companies started way back in July of 2021. Joining us now as part of our Crypto Corner, brought to you by Intuit TurboTax, is Ben Zweig, Revelio Labs CEO. Ben, thank you for joining me. So this is interesting because a lot of people wanted to put the blame on the fallout from FTX, but this started way before the FTX fallout. So what was happening? What was the writing on the wall?
Yeah, we thought that was interesting also. I mean, I think the one thing that's changed the most is the business outlook. And we did a piece on what are the biggest predictors of attrition, and business outlook is the biggest by far. And that has been falling since the Terra Luna crash. I think it's really that there haven't been a lot of proven use cases within crypto. And I think that's been worrying a lot of the employees, a lot of the workers.
So Ben, where are they going then? Are they still sticking with some of these crypto companies or really expanding their horizons?
Some do go back to crypto. I mean, we've seen a lot of churn in the markets just with the Great Resignation continuing, but most of them have been going to tech companies. Surprisingly few have been going to other financial firms, but it's really those 3 segments. So it's big tech companies, other crypto firms, and other financial markets companies. But that third is smaller than I think I would have expected.
And so when you think of red flags, not just for, say, if you're hiring someone who's coming from a crypto company, but even in the postings that you're applying for, what should they be watching out for?
Yeah, we've seen a lot of red flag postings. Really, work hard, play hard, things like that perhaps sound a little bit like there might be some hint of toxic culture or a sort of cavalier attitude toward work-life balance, toward benefits, toward just like a healthy relationship with work. So we've been seeing a lot of those with crypto companies as well. A lot of people, even in their Glassdoor reviews, have been mentioning keywords like toxic, leadership, transparency. These are things that were worrisome really all throughout 2022.
And how receptive are employers to former crypto bros who've worked at some of, especially if it's a place that everyone has seen collapse? How tough is it for them?
I think it's not so tough. I mean, crypto has had a not historically, but a relatively low attrition rate relative to other firms, especially within tech. It has been a really easy place to recruit talent. So crypto has this, veneer of cutting edgeness. They're super fans. So it's got a committed audience. And as a result, they've been able to find engineers and talent that are perhaps more talented than their counterparts who are going to work at some company where there isn't that glamour. So I think they've had an easy time recruiting talent and an easy time retaining talent. And now that things are kind of falling apart, I think there is this sense in the rest of the market that there are very talented people who work at crypto companies, and it's a good place to find people. I mean, we're still in a very tight labor market, and that companies are eager to find talented people wherever they can find them. So I think the fact that crypto has collapsed, I don't know if a lot of blame goes to the engineers working on the technology.
And just quickly, what are some of the side effects? Obviously, a lot of companies downsizing and cutting costs, but especially for companies that are trying to be nimble like a crypto company, what are some of the unforeseen side effects of having to cut costs and lay off people at this pace?
I think the cultural effects are pretty severe, and it's really hard to recover from this from these layoffs because you start having a negative outlook, and then people leave. And that just reinforces itself. And this is an industry where people go in because they think they're joining a rocket ship. And without that, it's harder and harder to keep people excited. So I think the effects that these layoffs have on the culture, is really hard to recover from.
I'll certainly be keeping an eye on that. Thank you for joining us with your insights. Ben Zweig there, Revelio Labs CEO. Thank you for your time this morning. All right, let's do a final check of the markets. Still a mixed picture as we head into the noon hour, although now we have two of them turning red. Now the Dow and the S&P, only the Nasdaq eking out some gains, up just about 4 points. I'm Rochelle Akufo. I will see you tomorrow at 11 a.m. Eastern.